Earlier, they released their earnings this morning. Those shares higher 1%. We've also had numbers out of Direct Line this morning. Those shares down 0.7%. Aberdeen, though, after their earnings, up 3.3%. So all of that to factor in. We're still waiting for the CAC and the DAX to open. Meanwhile, if we look at some of the chip names, ASML lower 2%, Infineon lower 1.8%. Again, it seems that the tariff story outweighing, as you said, Anna, the optimism that we may have seen on a different day because of TSMC planning to invest $100 billion in US chip plants that demand long-term for semiconductors, not really feeding into the rest of the sector there, but still waiting for the CAC and the DAX.
Yeah, waiting for those to open. From a sector perspective, we can see that energy is weaker. So thanks to the team for flagging that we had that big drop in oil prices yesterday after hours for Europe. And so that then being reflected by some of the big energy names. So that sector is down by 2.7%. As we watch that Brent price dropping again, so we've seen OPEC Plus suggesting that they will be open to increasing production, and so that is something that is weighing on BP, down by 3.8% today, Shell down by 2.6%. So that's the worst performing sector in Europe this morning.
Yeah, so all but two sectors in negative territory, and as you say, energy and basic resources bottom of the basket, just utilities and food, beverages and tobacco managing to eke out gains.
Santander is down by nearly 2%. BBVA is down by nearly 2% as well this morning. So that's Spanish read across into the Mexican market is also being represented by these early trades as well that we are seeing. Luxury names look like they're under pressure as well. BAE Systems, despite actually the analysts turning a little bit more cautious, is in terms of the points gain that we're seeing here in Europe this morning the biggest gainer. Rheinmetall opens up nearly another 5% higher after the gains that we saw being generated yesterday.
Yeah, Safran and Indra Sistemas also up this morning. So that defence positivity, if you want to call it that, continuing on the expectation of more that Europe needs to do on its defence.
BAE Systems up 2%, so yes, same as yesterday, definitely standing out to the upside, but not the same as yesterday in the scale of this. We had really substantial moves higher in defence stocks yesterday, didn't we?
But there's no rolling, there's no rowing back. We are continuing to move higher, which is interesting. That at some point you would argue that after the massive gains, I don't know how much Rheinmetall is up. 3.4. But year to date, it's up hugely.
Yeah.
At some point, are there going to be limits to what we're seeing in terms of the defence space here in Europe? And
at which point you start to think that it's the US names that are going to benefit from this extra spending.
Rheinmetall came into the beginning of the year at 600, but now trading at 1,175. So nearly a 100% rise in Rheinmetall stock.
Right, well, as we wait for the CAC and the DAX to open, we'll not leave it any longer. Let's bring in Henry Allen, macro strategist at Deutsche Bank Research. Your latest note came into my inbox. It really was a ray of sunshine, and I want to start there on this particularly down day. You still think that US stocks are, not just, they're still exceptional. There's still US exceptionalism. Do you think it's still just a blip, not a turning point in that narrative?
Well, I certainly think we're in a paradigm shift in the sense that Europe is finally waking up to the fact that they're going to have to do more on defence spending. But in terms of kind of where US equities are right now, this reminds me a lot of what happened last summer, to be honest, which is we've had this risk-off move, we've had this negative vibe shift. But at the end of the day, markets will go through a correction from time to time. A year like last year, where you hit a succession of all-time highs month after month after month, is not necessarily the norm. And at the end of the day, it was only 2 weeks ago, less than, that we had an all-time high for the S&P, and we're still only down 5% from that level, despite the array of risks that we've seen from tariffs to geopolitics to Trump uncertainty.
But some analysts are saying, you know, the chance of a recession is now higher when you factor in like the ISM manufacturing data. It's not their base case. I was listening to an analyst from Barclays on surveillance yesterday saying exactly this. Would you at least concede that a recession is more likely? In the US?
I really don't think so. I think that narrative about a recession is completely over-egged. I mean, firstly, trend growth right now is still running at 2.5% to 3%, so it would take a huge shock to push that lower. I also think that a big difference now compared to much of the last decade and a half is the Fed have a lot more space to cut rates. Because, of course, even for the last year or two or three, inflation was so high that, yes, rates were high, but they couldn't really cut rates because inflation was double their target. Whereas now, yeah, inflation's a bit above target, but only just lingering above. So if there were a more negative demand shock, the Fed now have a lot of space. They can cut rates just like they did last summer before you then saw a rebound.
Even though it looks like Trump's actually serious and literal on tariffs?
Well, I'd say even there, actually, we saw from his first term, every time you saw a big equity correction, every time you saw growth beginning to slow, that then coincided with him reining things back in a bit. So actually 2018, when growth was strong, he really pushed forward the trade war. As growth slowed into 2019, we had that big equity sell off the end of 2018, they then rode back, and by the start of 2020, just before the pandemic, they reached a phase one deal with China. So I think that pattern could repeat because the economy is so strong, because equities are near all-time highs. They have the space to be aggressive, and there are actually some natural corrective mechanisms if things do turn.
Isn't the risk growing, though, that the strike price of the Trump put is much lower than we think it is?
I think perhaps. I think certainly investors have been surprised just how aggressive he's been.
And he doesn't talk about the equity market. First term, he talks about the equity market all the time, I remember. This time, barely mentions it. Are we sure it's his metric?
I don't think it's his metric in quite the same way. I certainly agree with you there. But equally, it's not in Trump's interest for the economy to see a big downturn. And the US does have weaknesses here. One thing I've been struck by, for instance, is, yes, we've seen tariffs on Canada and Mexico 25% overnight. One exception, though, was Canadian energy, right? They only got 10% tariffs. And that's an acknowledgement that Trump has come into office saying, I want to bring down inflation. I want to bring down interest rates.
Right.
Tariffs are going to make that more difficult, and they're aware of that.
Should we assume that oil prices are the metric? Should we assume that... What do you think? Where is the pain point for... If it's not equity markets, what barometer do you think Trump is judging what he is doing and the effect that it's having? Let's assume that it's not the S&P. What else could it be? Is it yields? Is it oil prices? Is it consumer confidence? Where should I be looking?
Well, I think a couple of things. One is inflation, because, of course, they've criticised the former Biden administration so much for things like the price of eggs and what have you. If inflation does start creeping up from the 2s into the 3s or 4s, then that's a pain point, because then it becomes easier to blame Trump and the tariffs, and Democrats, indeed, are already trying to link up higher inflation to Trump. And then I think there's broader consumer confidence, particularly among small businesses, because Trump was proclaiming the fact that small business confidence had soared when he came to office. Right. So I think if you saw among his natural constituencies, perhaps his voters, they were hurting more, then I think that's also a pain point, particularly given in the US cycle, of course, we have the midterms, so that is going to come into the radar just over 18 months away from now.
So we look to inflation and we look to sentiment around small businesses, how they're both doing then, Henry, to get a sense of whether we see a change of course. If we don't see any change of course from the Trump administration, and this is the way forward for 2025, what does the best portfolio look like? What do you want to lean into? What get more exposure on?
Well, I certainly think European equities somewhere I'd be overweight on right now. I think there hasn't been enough, even with the rally we've seen year to date, I think there hasn't been enough of an adaptation that we are in a new normal when it comes to Europe's economy and European defence spending. That actually, if you do see some of those forecasts realised for higher defence spending, that can provide a huge fiscal impulse of the sort we haven't seen in some time. We've talked about in our research, potentially a 2% fiscal impulse of GDP for Germany going forward as a result of higher defence spending. They're going to have a coalition. Friedrich Merz has talked about one by Easter, so you could get more political stability in Europe going forward. And I think that's really galvanised European leaders, and indeed others like Canada and stuff, against the United States. So even if you do see tariffs on Europe, I think that Europe is going to be a key part of that portfolio.
So economists and guests we talk to seem to vary on their views as to how well a fiscal impulse that's driven by defence drops through into a more positive growth story. What dictates that for you, Henry?
Well, I think some of it depends on where the money is actually spent, in the sense that a lot of this defence spending, and indeed Zelensky was arguing this in recent months, actually flows through to the United States. How much that flows through to the US as opposed to Europe. But actually one thing I think could change now, because you're seeing trade relations deteriorate, is that governments in Europe, in Canada and other countries are going to say, actually, we're going to make very, very sure that this defence spending is concentrated here at home. Actually, one thing I noticed, for instance, when Keir Starmer announced higher defence spending in the UK, was they were saying actually how this would benefit businesses here in the UK. They were very much driving that as a domestic positive economic story, not just one about military spending.
Gonna leave it there. Nice to see you, as ever. NFIB, just out of interest, out on the 11th, next Tuesday. Henry Allen, macro strategist at Deutsche Bank Research. Let's take a look at the core six. What are we seeing in terms of the story here in Europe this morning? As you can see, a little bit of a defensive bid. Nestle is up, everything else is a little lower. But let's look elsewhere for some of the other big moves. Joe Easton has the details.
Some weakness as expected in the auto stocks this morning, given news of these tariffs coming into play now. Seeing the German names coming down, Volkswagen down around 2%, Stellantis as well 4%. But the big move, the Continental, given the significant miss on some of the company's margins coming out of Germany today. So that one is the big underperformer. And also a sector that is moving lower as well is energy. We did see Brent crude coming off around 2% since the close of European trading yesterday, as was discussed earlier in the show. So the big decline is BP, Shell, Eni, all of them dropping today. Significant weakness on that sector. Then over in defence, Thales off to the races. A massive jump in that one, up almost 10%. Does look like it was potentially in a hole, but it is ticking now, up 9.7%. A big step up in orders once again, and that does seem to be feeding through into the broader sector a little bit as well for that one. Then in terms of Fresenius, getting hit in terms of Fresenius Medical, that one is a share placing. Aberdeen has brought its vowels back into its name, according to their statement. They are going to be known as Aberdeen, as it was traditionally spelt. They've also seen a jump up in their fund flows as well. And finally, nearly time to buy those Easter Bunny chocolates from Lindt, and they are seeing a decent gain today. That stock up almost 4% as they navigate the step up in cocoa prices. Strong margins for Lindt, boosting that stock in Switzerland this morning, up 3.5% today.
The return of vowels to Aberdeen is a positive for news anchors everywhere. Joe Easton, thank you very much. Joe Easton from our equities team with a rundown. Coming up, we will continue to talk about the defence story this morning. We're moments away from a press briefing from European Commission President Ursula von der Leyen. That's next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Minutes into the equity market session this Tuesday morning. European equities are on the back foot. We had to price in the negative session that we saw yesterday in the United States. There are some bright spots, though. Defense stocks certainly continue to move higher. Dassault Aviation, Thales, Kongsberg, MTU, Rheinmetall, all hitting fresh 52-week highs this morning. That sector continues to push higher. Other areas, though, that we are focused on this morning include those affected by tariffs. The auto sector in Europe certainly being significantly affected. As you can see, we are seeing negativity coming through this as President Trump's tariffs in Canada and Mexico are said to add around $60 billion to the costs of the industry. This is according to research from the consultant Alex Partners. For more now on the levy impact and what it means for the business, our global auto editor, Craig Trudell, joins us around the desk. How much is a car going to cost in the United States after these tariffs have been pushed through? How much more is a car going to cost?
The estimates here are a little bit all over the place, but just yesterday, our Keith Naughton in the Detroit Bureau reported on a recent study done by Anderson Economic Group, which is a group based in Michigan that regularly does these sort of economic impact studies. Roughly $4,000 for a crossover SUV, and the incremental cost to build that would be passed on to the consumer. In this study, one of the electric vehicles looked at estimated about a $12,000 increase. So this is, of course, already a situation where we've seen a pretty dramatic run-up in prices for vehicles in the U.S. already, where we're approaching, on average, it costs you $50,000 to buy a new vehicle. So this is sort of the last thing that the consumer is looking for, I would suspect, across the market, that there's going to be some real sort of resistance to these increased prices.
So that's the impact on the US consumer. You're looking, though, at the impact on the European automakers this morning. Just talk us through why that's happening.
Yeah, I mean, I think this is not going to be necessarily a situation where there are any winners, right? There's even Ford, where you have a situation where this is the automaker that employs the most U.S. workers, that has the most U.S. production. Their CEO just a few weeks ago was talking about the idea that these tariffs would blow a hole in the American auto industry, and alluding to the idea that Trump has talked about wanting to look out for the American auto industry, and instead what we've gotten is a lot of costs and a lot of worries, a lot of reasons for concern. So this is a situation where Stellantis has quite a bit of production both in Canada and Mexico. Virtually the whole industry over the last decade and a half has gone into Mexico because of the lower cost production. And so this is going to be sort of, widely felt because of the interconnectedness of the supply chain.
So we see European car companies down as a result of that very thing then. Craig, what about Continental? That's obviously a supplier to the auto industry, down by 8.5% this morning. The narrative applies, perhaps, or at least the vulnerability linked to tariffs applies, but also we've had numbers out.
Yeah, I think this is also a company where just the fact that it is so strong among German original equipment manufacturers. We've talked an awful lot about the Germans really having challenges the last couple of years even. And this is a case of both your customers falling on hard times. I think Continental, some of its own businesses have not done particularly well, and they're now trying to do a spin-off of their biggest business and really sort of focus in on tires, which is the one part of the business that is doing reasonably well. You don't spin off a business in the midst of all of this tumult and all of these challenges unless it's more of a need as opposed to a want.
New standards or delayed standards in Europe. Europe is realizing that it can't go as quickly as it wants in terms of the energy transition for the auto sector. Talk through the effects of that. A 3-year delay, how much does that impact these companies? How much of a respite actually is it? We saw a big bounce yesterday in some of these stocks. We're reversing that today, but talk through the effect.
I mean, I thought it was fascinating yesterday that, less than 2 hours before Ursula von der Leyen made these comments about, as you alluded to, going from this year being the sort of, make or break year to meet tougher CO2 standards, the manufacturers will have, 3 years where if they don't hit the numbers that they need to this year, they can sort of, make up for it in the following 2 years. Less than 2 hours before that, Volvo Car was saying, don't do this. We've made these investments. This industry has had years with this writing on the wall that they need to, sell more EVs. And, we made the investments. We're committed. You can't do it. And I do think that they're a sort of, lonely voice. A lot of their peers were really sort of begging for this. I also think that we're in a sort of situation where we're kind of making it somewhat inevitable that it's going to be more difficult to meet these standards when we're starting to see more of these manufacturers reinvest in combustion cars. Mercedes bringing a new V8 to market, Porsche going back to combustion models. So I have a real question about, the fact that some of these companies were doing this before even waiting for the policy changes to take place. Of course, the other side of that argument is this is, bowing to reality that the consumer's saying we're just not ready yet.
Okay. Bloomberg's Global Autos editor, Craig Trudell, we thank you for the analysis. And a reminder that you're going to be hearing from the CEO of Continental, Nikolai Setzer, at 9:30 a.m. London time on The Pulse. I'm sure we'll hear more about the tariff story in that conversation.
We've talked a lot about tariffs this morning. Let's go to another of our top stories, of course. Donald Trump has paused all U.S. military aid to Ukraine just days after his Oval Office bust-up with President Zelensky. A Defense Department official has told Bloomberg it won't be resumed until the U.S. president determines that Ukraine's leaders are demonstrating a good faith commitment to peace. Let's get more from Bloomberg's Oliver Crook, who's been following this, of course, for us. So what a good faith commitment to peace would look like, I don't know. There's a lot of talk about how much of an apology would Zelensky have to make here. But let's talk about what this means, this pausing of aid, military aid, to Ukraine. What does it mean for Ukraine's ability to keep fighting right now?
Yeah, I mean, I think that there's sort of varying sort of ideas of how long the sort of aid from the Europeans in terms of the actual hardware can keep the sort of Ukrainians fighting. There's some estimates that basically takes them basically to the summer, maybe some distance into it. But again, this is, as we've known from the very beginning, the U.S. is the #1 supporter of Ukraine in terms of the actual military aid. The Europeans can mobilize a lot of money, and they have been mobilizing a lot of money. But at the end of the day, the Americans hold basically all the cards when it comes to the hardware. And what we understand now is that it has been officially paused. That means that things that are even in transit right now, that are in the air, that are getting to Ukraine, will be sort of stopped somewhere else. Things that are in Poland that are waiting on the border are not going to go into Ukraine. And this is, of course, maybe not totally unexpected after we saw what we saw on Friday, but is, of course, very material.
European defence stocks have been rallying heavily. There's an expectation, clearly, that we're going to be seeing a lot more money spent, and these companies are going to be producing a lot more going forward. How quickly does that happen? And is there anything that can be done near term for Ukraine to fill some of these gaps?
So listen, I think that what's very interesting, I remember we went to a Kongsberg, one of the missile factories that they basically opened up. I think it was this summer, basically, when we had gone over there to see basically this new installation. They make the Joint Strike missiles that go into the F-35s, the Naval Strike missiles that go that hit targets at the sea. This is a project that they had begun doing before the invasion of Ukraine. So you take that back 2.5 years, basically, when they had the idea to expand this. This is the kind of timelines that we're talking about for these military companies to sort of boost production. Of course, if you flood more money into it, things can happen at a more accelerated pace. But you look at all of these order backlogs. All of these companies have record backlogs on their order books. So actually getting the volumes up is the the great difficulty. And again, at a time in which the sort of Russian economy has gone basically to full wartime economy, churning out tanks and ammunition every single day.
Ollie, clearly the point of Trump doing this is to put the spotlight back on Europe, to step up itself. And we heard about this coalition of the willing that Starmer and Macron want to put together. But then you've had this open dispute, right, between Macron and Starmer on this idea of a 1-month truce. Where are we on that?
Yeah, I mean, listen, I think that basically trying to evaluate where we are after the meeting on Friday is a very difficult thing to say, because this minerals deal, I think in the minds of the Ukrainians and the minds of the Europeans, was supposed to put an end to the war, i.e. begin to pave the architecture for those security guarantees to put an end to things. Now the United States doesn't want to commit to that. The Europeans are saying that basically Trump is going to have to get in some way what he wants. So can we just sort of spin this as maybe a sort of temporary measure that we hold for a month until we sort of negotiate what the actual long-term deal looks like? But again, it puts everything in sort of constant flux, and the fear from the Europeans and the Ukrainians is that this only basically gives Vladimir Putin time to build things back up. And we heard from the Kremlin yesterday basically saying that their view of the world internationally aligns more with the Trump administration.
Oliver, let's pause there and listen to what Ursula von der Leyen is saying. She's giving a briefing. I assume we can go and listen to her words now.
We're living in the most momentous and dangerous of times. I do not need to describe the grave nature of the threats that we face or the devastating consequences that we will have to endure if those threats would come to pass, because the question is no longer whether Europe's security is threatened in a very real way, or whether Europe should shoulder more of its responsibility for its own security. In truth, we have long known the answers to those questions. The real question in front of us is whether Europe is prepared to act as decisively as the situation dictates, and whether Europe is ready and able to act with speed and with the ambition that is needed. In the various meetings in the last few weeks, most recently 2 days ago in London, the answer from European capitals has been as resounding as it is clear. We are in an era of rearmament, and Europe is ready to massively boost its defense spending, both to respond to the short-term urgency to act and to support Ukraine, but also to address the long-term need to take on more responsibility for our own European security. And this is why today I have written a letter to the leaders ahead of Thursday's European Council. This is why we are here together today. I have outlined in this letter to the leaders the Rearm Europe plan. This set of proposals focuses on how to use all the financial levers at our disposal in order to help member states to quickly and significantly increase expenditures in defense capabilities, urgently now, but also over a longer period of time over this decade. Now, there are 5 points to this plan. The first part of this Rearm Europe plan is to unleash the use of public funding in defense on the national level. Member states are ready to invest more in their own security if they have the fiscal space. So we must enable them to do so. And this is why we will propose to activate the national escape clause of the Stability and Growth Pact. This will allow member states to significantly increase their defense expenditures without triggering the excessive deficit procedure. So if member states would increase their defense spending by 1.5% of GDP on average, this could create fiscal space of close to 650 billion euros over a period of 4 years. The second proposal will be a new instrument. It will provide 150 billion euros of loans to member states for defense investment. This is about basically spending better and spending together. And we're talking about pan-European capabilities, domains like, for example, air and missile defense, the artillery systems, missiles and ammunition, drones and anti-drone systems, but also to address other needs from cyber to military mobility, for example. This will help member states to pool demand and to buy together. And of course, with this equipment, member states can massively step up their support to Ukraine. So immediate military equipment for Ukraine. This approach of joint procurement will also reduce costs. It will reduce fragmentation, but it will increase interoperability and, of course, strengthen our defense industrial base. And it can be to the benefit of Ukraine, as I've just described. So this is Europe's moment, and we must live up to it. The third point is using the power of the EU budget. And there's a lot we can do in this domain in the short term to direct more funds towards defense-related investments. And this is why I can announce that we will propose additional possibilities and incentives for member states, that they will decide if they want to use cohesion policy programs to increase defense spending. Now, the last two areas of action aim at mobilizing private capital by accelerating the Savings and Investment Union and, of course, through the European Investment Bank. So to conclude, Europe is ready to assume its responsibilities. Rearm Europe could mobilize close to 800 billion euros of defense expenditures for a safe and resilient Europe. We will, of course, continue working closely with our partners in NATO. This is a moment for Europe, and we are ready to step up. Thank you very much.
Thank you. No questions today. No questions today.
Europe moves forward in a crisis. We have reached that point. Ursula von der Leyen, the Commission President, laying out a series of measures that will be pushed forward and proposed by Europe in order to significantly boost defence spending. Stocks have already front-run this to a certain extent. We are seeing escape clauses being activated in terms of current fiscal rules. Europe is going to move forward with this. We've been waiting for this moment for quite some time. That moment has now arrived. What are the implications, and there are many of this? You could think about inflation, you could think about the labour market, you could think about all kinds of aspects to this. This is going to have a significant impact.
Yeah, is 800 billion euros the number then we attach to this? This is the number she was giving us. Rearming Europe could mobilise close to 800 billion euros. But Ollie Crook's still with us, of course, listening to that as well. I mean, some of that's in loans, Ollie, but there is an emphasis also on national funding, freeing up fiscal space, a sort of jigsaw of measures to get to that 800.
Yeah, so a lot of the stuff was sort of flagged in advance, the things that we were sort of anticipating. So specifically the public funds at the national level, basically those carve-outs for basically being able to get more and more debt at the national level, saying that, you know, that's going to be worth about 650 billion euros potentially over 4 years is where they're saying that. That's point one of the plan. Point two is more defense loans sort of from Europe, and these are sort of pan-European initiatives for air defense. Joint procurement is something we've been talking more and more about, even outside of the EU. The EU budget, additional incentives. Now, this is, I think, maybe the biggest of all of this, the cohesion funds now basically being eligible to move to be spent on defense. And then, of course, the sort of private capital, which always goes into a bit of abstraction. Capital markets. She raced
through that bit at the end.
Yeah, and
points 4 and 5.
Yeah, exactly.
Private capital will do things.
Yeah, exactly, which is always the sort of silver bullet we're hearing from the EU. But then the EIB, she did mention, she didn't go into the details. Does this mean?
That's hard to do, isn't it?
Yeah, and so the difference is this. What they did already is they sort of expanded the mandate so you could buy dual use within the EIB investment. Can that now be, or are they going to talk about basically repurposing that to just military spend? That would be another significant boost.
But do you not think that there'll be worries politically about procuring together and sharing these funds and sharing weapons, essentially, when, you know, we've just seen how fast things can change politically around the world?
Absolutely.
What if the AFD is...
Well, and how willing are all the members of the EU on this? Because what we saw in London was a coalition of the willing. That was not the same as the European Union. Some members of the EU were not there, notably, and there were plenty of willing people outside the European Union, like the UK, like some of the Nordics, that are not in the EU as well.
Joint procurement sounds logical. The US joint procures. It has one military budget. That is how it's spent. It figures out the programs that it wants to apply, and then it applies significant amounts of money to them. Europe probably needs to take some lessons from that. I appreciate the conversation we had yesterday about maybe the need for competition to improve products, and I think that is something that I think Europe will need to talk about. There was some talk about some of the Russian money being used for this. That doesn't look like that's going to happen. There's no joint debt here in the same way that we've maybe talked about in a similar way to the COVID crisis. So I think those are two interesting aspects of this. But where do the people come from to build this stuff? Airbus already has a crisis in its supply chain of a lack of staff, a lack of trained staff to build civil kit. Where does the staff come from to build the military kit? This is a long-term process. You've got to build the facilities. You've got to train the people. This is not something that happens overnight.
So building the kit is obviously one question. There's also operating the kit. So let's deal with two of these issues, right? The building it, we have seen to a degree, for example, the sort of decline of the auto sector has been a benefit to the military-industrial sector. We spoke to Henselt around this very table, talking about taking full teams from the auto sector and basically incorporating them within their own. Within their own structure, taking over, an old, I think it was an Alstom train factory to basically go to the military, redirecting. I mean, you can move this stuff. Again, it will take time. There is some know-how, certainly in Germany, for example, on the industrial level. But then again, there's also the question of this military build-out, the actual people, the people that operate this gear. I mean, we look at the numbers of the military in Germany. Germany has a military of 180,000 people. It's a country of more than 80 million. It's tiny. The United Kingdom, it's the same thing. They need to start talking about it. And this is one of the conversations I had with the top general from the German military. There is a conversation about potential conscription light. All of these things are coming and emerging in political discussions more and more within Europe.
Thank you very much, Ollie. Bloomberg's Oliver Crook with the latest on the defence story, and just listening there to Ursula von der Leyen, of course, talking about what Europe is planning. Not much reaction then, Lizzie, when it comes to bond markets. Interesting that yields were lower and they remained lower.
Yeah, indeed. So the German 2-year down 4 basis points at 2.02, the 10-year down 3 basis points at 2.46. Maybe look to the euro for a bit more of an embrace of this. It's stronger, 0.25%, 105 is where we trade, and we already had a boost to the defence stocks.
They're not up. As you were speaking, defence stocks weren't rising. So that's already, to a certain extent, been priced in. But is there a question? ECB's coming up. Is this all going to be inflationary? Is this something that Europe needs to think about in terms of an inflationary impulse? Or is it a growth impulse? How should we primarily think about this?
And what's the role of the ECB? You know, von der Leyen saying there we'll use all the financial levers at our disposal. Is it on the ECB to make this more affordable?
Russian assets, perhaps? I mean, that's the conversation we had yesterday with Tim Ash. He was saying that the ECB, in his view, the ECB is blocking this and should not be. That was his view. Let's pivot from this defence conversation in Europe, which we will certainly get back to other foreign policy matters globally. A delegation from Africa's economic giant, Nigeria, is in town this week. The country's Minister of Foreign Affairs is in London to meet with the UK counterpart, David Lammy. With growth and security high on the agenda, of course, Minister Yusuf Tugar joins us now. Minister, thank you very much for coming to speak to us. Thank you for being with us here on Bloomberg TV. So you join us at a really busy time in London over the weekend. There's a lot happening geopolitically. President Trump in the White House once again. What have you made of your visit to the UK so far? What have you achieved?
We have had discussions to do with security, which is of great concern to both nations. We already have a strategic partnership which covers different sectors. We're also looking at opportunities in digital technology, in IT, in the startup ecosystem. So particularly business process outsourcing. We see it as a solution to migration, irregular migration, as well as this problem we're having to do with issuance of visas to Nigerian students.
Okay.
With applications that have applied successfully to.
Okay, so a host of issues on the table and to be discussed then in your visit here to the UK. Are you concerned, Minister, big picture, that if the UK and Europe, we've just seen it demonstrated there by Ursula von der Leyen from the Commission, everybody's very distracted by the defence conversation in Europe. There is war in Europe, and that is dominating and taking a lot of the airtime. Are you concerned then that Europe has less of an interest in Africa, less time for Africa, as a result of that?
Europe can ill afford to have less of an interest in Africa because we're neighbors. The Mediterranean in Latin is water in the middle of land. That's what it's always been. And we are more interconnected than we perhaps realize, because the Atlantic economy, if you will, goes back centuries, and we've been interacting with each other. So what concerns us concerns Europe. And Nigeria is the front line in many regards. When we look at the issue of security in the Sahel, migration, these are climate change.
Yeah, and I want to come back to that. And Minister, it's so good to have you with us round the table. It may well be that Europe can ill afford to have less of an interest in Africa, but of course we know that for the UK's part, in order to ramp up defence spending, they're cutting the aid budget. I wonder if that's something you discussed with the Foreign Secretary David Lammy, and how it changes how you're going to be, trying to attract investment to Nigeria.
Nigeria has never been reliant on aid. What we have always sought for is strategic solutions to the issue of risk, so that we can partner with countries and mitigate risk. We're looking for countries that meet us halfway, and the United Kingdom is very much aware of that. So what we were taking in terms of development aid is really not that significant, and it's being covered by some of the initiatives that have followed. For instance, the cutback on USAID, PEPFAR. Our Minister of Health announced that Nigeria was stepping up to cover any shortages that might accrue. So really, Nigeria is not the model country when it comes to the issue of reliance or dependence on aid.
And you talked about the security concerns. We talk a lot around this table about China's role in Africa. I think something that gets less talked about is the growing influence of Russia in Africa, in terms of paramilitaries, arms supplies, economic ventures. Is that something that you think Europe should be more concerned about?
Absolutely, particularly since Europe pulled out and Russia is coming into the Sahel. So the Sahel is our neighborhood, and part of the problem, or the reason why Europe had to pull out, was exogenous solutions were applied without including countries such as Nigeria. You could see the difference when Nigeria participated, leading ECOMOG, in Sierra Leone, in Liberia. You could see how far we're getting on with the multinational joint task force in combating terrorism. But we were not part of G5 Sahel. We were not part of Operation Barkhane. We were certainly not part of the EU Sahel strategy. So we consider the EU as our partners, Europe as our partners, and we're looking for solutions that are organic, and we that live in the neighborhood are in a better position to come up with the ideas and get the support and the buy-in of our partners. And our approach is strategic autonomy. We get along with China, we get along with the US, we certainly get along with the European Union.
If the European Union spends less time and money focusing on Africa, spending on the Sahel, does migration go up?
Migration would go up, certainly, if Europe spends less on investments, on infrastructure, and on tackling some of the problems that were brought about by the actions of Europe. Libya, for instance, where all the weapons are flowing in from. You have trained fighters. You have now forces exiting Syria and looking to relocate in Libya. That's going to be a problem. And for as long as weapons and funding and trained fighters cascade down from Libya into the Sahel, we will continue to have a problem. And this is what we're looking to address collectively through multilateral channels. And multilateralism can exist side by side with national interests. It's the way it should be.
Minister, great to see you around the table this morning. Thanks for stopping by to see us here at Bloomberg.
Thank you.
Thank you very much indeed. Nigeria's Minister of Foreign Affairs, Yusuf Tuga. Thank you very much. Coming up, we're going to be joined by Kellyanne Shaw, who served as Deputy Assistant to the President for International Economic Affairs during the first Trump administration. It's an interesting morning to speak to Kellyanne. We'll do that next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Up-to-the-minute global financial news whenever and wherever it happens. I'm Jonathan Ferro.
And I'm Lisa Abramowitz in Davos, Switzerland, and this is Bloomberg.
Welcome back. We are 47 minutes into the equity market session. As you can see, we are negative to a certain extent. That is a pricing in of what we saw yesterday on Wall Street after the tariffs were announced in the United States, plus a little bit of ISM manufacturing data to dampen the move even further. We've seen an announcement this morning, a significant announcement by Ursula von der Leyen in Brussels talking about defense spending. We'd already seen a pretty substantial rise in defense stocks, but they are up again, and many of them continue to hit 52-week highs. But the broader narrative this morning remains what we are seeing in terms of the tariff story. Many people surprised, you could argue, by the escalation that we saw in the trade war yesterday. Let's get an expert voice, hear from an expert voice on this subject. Kellyanne Shaw, partner at the law firm Hogan Lovells. Kellyanne served as Deputy Assistant to the President for International Economic Affairs during the first Trump administration. She was also lead negotiator for the US at the G7, G20 and APEC on this very subject. Good morning.
Good morning.
Nice to see you. Are you surprised this morning that they went into force yesterday, particularly Canada and Mexico?
Yeah, I think that my base case was an additional suspension, given the fact that the administration had signaled there had been cooperation on border issues and there were historic lows in terms of the number of border crossings. But at the same time, it was very clear that they were not satisfied with the level of cooperation on fentanyl. But nevertheless, I thought there might be a suspension. The president moved forward, and we are where we are this morning.
So how long does the current phase last for? how long should we think about these tariffs being imposed for?
Yeah, well, I think about it in two different ways. So first, this is the new normal in terms of realpolitik, using tariffs in the same way that the United States traditionally uses sanctions policy to try to get another country to do something. So this is not about economics, it's about national security and security issues. Right. So they're designed to be in place for a very short period of time. But at the same time, it's not really clear what the landing zone is here. So to the extent the president is looking for a reduction in the number of deaths related to fentanyl, that's not something that's going to play out in a matter of days or weeks. That's going to take months, if not years, to see in terms of the numbers. So it's not really clear to me where this goes.
So difficult for the other parties in this dispute then to show quick wins, I suppose, from that perspective. Kellyanne, let me just play a sound. We've got a little clip of the Ontario Premier, so just one part of Canada where emotions seem to be running high. Let's just have a little listen and see what you think.
A tariff on Canada is a tax on Americans. If they want to try to annihilate Ontario, I will do everything, including cut off their energy, with a smile on my face. And I'm encouraging every other province to do the same.
So just for Kellyanne's benefit and to reiterate, he was talking about the potential for Canada to cut off parts of American energy supply. He said with a smile on his face. The point of playing that really just to illustrate that emotions are running high. You've been in lots of trade negotiations where I'm sure emotions run high. What does that bring to the table? That adds another level of unpredictability, I suppose.
Yeah, and the Canadians and Mexicans have both said that they intend to retaliate, and China has also expressed its retaliation for U.S. agriculture. So I don't think the administration will be surprised by that. And the president has tried very much over the past few weeks to message that the United States doesn't need Canada as much as Canada needs the United States, to try to undercut some of the legs from this potential threat of retaliation. But of course, Canada is going to. They feel very much that they're being attacked. They're going to push back. But that's normal in trade relations. And we saw that in Trump 1, too, where countries retaliated against the steel and aluminum tariffs. China retaliated against the China tariffs. Yeah. So I'm certainly not surprised, and I don't think the administration is either.
So do you think that this strategy can be used by America to get, as you described, national security wins? And does it come with an economic cost?
Yeah, but again, it depends how long these tariffs are in place. And to the extent that they're being used to drive an outcome on fentanyl, and they are, again, not designed to stay in place long term, I think it could ultimately make North America as a whole much better off and much safer and more secure. But if this drags on for a long period of time, I think that's going to pose challenges to the broader economic relationship.
Kellyanne, we were listening to Ursula von der Leyen speaking earlier. Let me take this to the European perspective. How should we be thinking about Trump's strategy when it comes to using tariffs as leverage to get what he wants on defence when it comes to the war in Ukraine? And how should Europe be responding to that?
Yeah, well, so far he hasn't done that in terms of threatening tariffs on Europe for cooperation on defense. He has said multiple times that he wants Europe to pay more. And so I think the announcement by von der Leyen this morning is very consistent with U.S. goals about having a partnership, a transatlantic partnership on defense. And there might be some benefit on both sides of the Atlantic with respect to her announcement. The tariffs he's threatened on Europe have to do with reciprocal tariffs like the automotive tariff, pharmaceutical products, the VAT tax, and other measures that Europe has taken on the economic side. And so I think in terms of trying to understand Trump's frame of mind on tariffs, he really does bifurcate them between the security issues, which we're seeing with Canada, Mexico, and China, and then the economic issues, which is where I think he's going to go with Europe.
Okay, that's really interesting that you still think that they're separate. In terms of the UK then, Trump saying that we are going to get a trade deal between the US and the UK, or at least talk about it. Is that more about the numbers? Because it would seem from the numbers that the UK doesn't need to be tariffed, but is it also, how much is it about the personal relationship between the two? Because we know that with Donald Trump, it could be quite volatile.
What I would say is that there's always the substance behind it, right? And I think the administration has said that the UK is similarly situated to the United States in terms of the overall trade levels, tariff levels, and that they're not as concerned about the UK as they are with Europe. But as you pointed out, President Trump's also incredibly relational. Yeah. And that relationship matters a lot at the top. And that's why Japan had such a successful relationship with Trump during his first term because of Prime Minister Abe. And you're seeing some of that same dynamic with Prime Minister Starmer. The two of them seem to have genuine connection and genuine chemistry, and I think that's going to be beneficial for the UK.
Can I come back to a question which I think you've alluded to, which is what is the metric by which some of these different tariffs are judged by the Trump administration and by the president himself. The market is now in a new phase of trying to understand where we are, and it's going to be looking for answers, that sort of signposts that can tell us kind of how long these tariffs are going to be applied for. If it's a national security story with Canada and Mexico, does the economic data, does the level of the Dow or the S&P or what the economic data are telling us matter, therefore, when we think about how long the tariffs are going to be applied? If the US economy starts to sort of have a meaningful hit from this, is that going to resonate in the White House?
I don't think that the White House is immune from that. And we certainly saw the S&P go down yesterday in reaction to the potential looming tariffs. And at least by the time I woke up this morning, the futures market was down slightly, but not as much as you might think. I think it in part depends how long these tariffs are in place. But again, I think he will address some of the economic concerns with Canada and Mexico after April 1st, when all of those economic reports are due to the president and as part of the USMCA renegotiation. The markets matter, but so do a lot of other factors. And I think in terms of President Trump's Pavlov hierarchy of needs and the issues he cares about, border security and immigration is number one, and Trump's effectively everything else.
Okay, really interesting insight into the mind of Donald Trump from someone who knows it well. Kelly Anshaw, partner at Hogan Lovells. Really great to have you with us. Thank you.
We have come a long way in our understanding of what Europe is prepared to do when it comes to defence this morning. We were hearing from Ursula von der Leyen just in the last hour, worth recapping, a lot more flexibility, a lot more fiscal space for national governments when they want to spend money to rearm Europe. We are in an era of rearmament, she said, and together she adds it all up to 800 billion euros worth of money, whether that's loans or private sector initiatives, so we'll be digging into the detail of that. Cohesion policy now can be used for defence spending, so we've come a long way, Guy. Defence stocks have been doing well yesterday and again today.
Well, continue to rise. So Dassault, Thales, Kongsberg, MTU, Rheinmetall, all hitting 52-week highs this morning. Thales out with numbers. It is up by circa 10% on the back of those figures, plus also the rise that we're seeing broadly across the space. But there's a sort of almost a duration mismatch here between what Europe needs now and what it is going to be able to achieve now, what ultimately the investment we're talking about today is going to mean further down the road. It's going to come further down the road.
And she was talking about spending on short-term Ukraine needs and long-term on Europe's own security.
Is Europe going to buy from the United States? Some of this short-term money, does it end up going into the United States simply because they have the capacity to provide
Part of the conversation with Tim Ash yesterday, certainly saying that the US defence companies are winners here. That is it for the opening trade. Busy morning, 8:56 here in London. The Pulse is up next. They'll continue to follow these markets and the defence story for you. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology. the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
President Trump delivers on his threat to hit Canada and Mexico with sweeping tariffs and doubles on existing charge on China, sparking swift retaliation and plunging the global economy into a deepening trade war. The EU proposes extending 150 billion euros in loans to boost defense spending. President Trump, meanwhile, orders a pause to all military aid to Ukraine. And European stocks slump on concern that the region could be next to face U.S. tariffs. Investors await Trump's speech to Congress for hints on future steps. Now let's take a look at the European markets map. Again, there's a lot going on. It's not only about Ukraine and geopolitics, it's really about these tariffs. Stocks in Europe seem to be retreating. You can see the DAX down some 1.7%, the FTSE MIB down 1.7%. I guess the FTSE is a little bit more immune because of the nature of some of the stock sets. In the index, the CAC 40 down some 1.2%. Again, there's a lot of concern in Europe that not only all of this uncertainty means that chief executives don't spend in terms of capex too much or reinvest in their companies, but there's a lot of concern amongst officials that Europe could be next in terms of U.S. tariffs. Now, the new levies really mark Trump's biggest push to remake global trade. Investors watching his address to Congress today for more news on what happens next. This is also filtering through some of the other asset classes. Now, the S&P future is practically unchanged. The U.S. 10-year yield for 1.644 and then euro-dollar 105.18. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, China and Canada have hit back after the U.S. escalated the global trade war. Well, 25% tariffs are now in force on U.S. imports from Canada and Mexico and 20% on Chinese goods. Beijing responded with levies on U.S. farm goods, with Canada targeting cars, trucks, steel, and aluminium. Brendan Murray, who coordinates our trade coverage, joins us now. Brendan, it's a big day for trade across the world. It feels like it's a little bit worse than maybe expected because of this tit for tat.
Yeah, exactly. We've seen 4 or 5 weeks from President Trump of threats. We saw it against Colombia. We've spent the past 4 weeks with this hovering over Canada and Mexico, and now it's a reality. Markets reflected that yesterday. The U.S. equities took a sharp dive. We'll see what happens today, and whether today becomes not tariff day but retaliation day. Mexico, we've still yet to hear from them about how they're going to strike back against American products. And then what's next? Is tomorrow exemption day? Does the economic damage start to emerge? And does President Trump say, all right, we'll exempt the auto companies, or to kind of dial things back? But at the moment, we're looking at one of the worst, the broadest regional trade wars that we've seen in a long time.
Yeah, and Brendan, I mean, so he's addressing Congress, which means that we could see something against Europe, which is why we're seeing stocks fall in Europe.
but we don't really know. There's a lot of uncertainty. You don't know whether they get taken off, whether they're, this tool of using to make a deal means that there's more economic uncertainty, actually.
There's no timeline for talks. I would venture to guess that the Canadians and the Mexicans don't know what goals they need to reach. What specific measures is Trump asking for them to do? We've just kind of launched into this open-ended, tariff tit-for-tat situation with 5 times the amount of economic activity involved as there were in the first Trump term.
Okay, Brendan, thank you so much. Brendan Murray there, who coordinates all of our trade coverage. Now, the European Union will also propose extending 150 billion euros in loans to boost defense spending, with the U.S. President Donald Trump pulling back American security on the continent. The European Commission President Ursula von der Leyen made the announcement in Brussels over the past 30 minutes.
We are in an era of rearmament, and Europe is ready to massively boost its defense spending, both to respond to the short-term urgency to act and to support Ukraine, but also to address the long-term need to take on more responsibility for our own European security.
Let's bring in Bloomberg's Ollie Crook. Ollie, the European Union is basically, proposing to extend this 150 billion. It's then up to the countries to see whether they want this leeway. It's basically the European Union saying, look, we're going to let loose a little bit.
Yeah, exactly. So now it has a name. It's called the Rearm Europe Plan. So that is something, sort of all the different parts that we've been reporting on over the last couple of months of what the things that this can include. We now have a definitive outline from Ursula von der Leyen, which is a 5-point plan that she just laid out. I'll just go quickly through those points. The first is the question exactly that you mentioned of public funding, basically making the fiscal space for each at the national level to basically borrow more and basically have carve out for anything that's defense spending. She says that could free up 650 billion euros over 4 years at the national level. There is this other loan, which is 150 billion, which would be extended potentially from the EU for pan-European defense initiatives. Something like an Iron Dome style is one of the things that has been discussed at the European level. There is this sort of EU budget. Now, this is an interesting thing. They basically will say that it's okay to repurpose European cohesion funds towards defense. This is a significant step. And then there's a sort of private capital. These are always a little bit more abstract. They want to make progress on the Capital Markets Union. They said this will unlock a huge amount of money. And of course, the European Investment Bank. Could they expand the mandate even further to go not just dual use, but to spend just on military hardware?
In general, I think it could unlock some 800 billion euros if done. Of course, there's a lot of these budgets that are under constraints at home after COVID. The big question is also, is the UK part of this?
Exactly. And what other sort of initiatives could there be? There's also this other proposal that's been discussed, a rearmament bank, which would basically be something that you set up sort of independently. It's backed by nation states that could opt in. This could give them a little leeway to be beyond the European Union. But again, we have come short from the sort of big bazooka, which is joint debt. This is also going to be a conversation at the EU level with the leaders. They probably won't make progress on it right this moment. But there's national funds at the European level. There's national funds now also at the German level. We've had reporting hundreds of billions of dollars potentially that would go around the budget. But as you say, Francine, and this is the critical point that I don't think has really hit home for Europe, if that money goes towards defense, it's coming from somewhere else, and everybody is strained across Europe, whether it's the UK, France, Germany.
Ollie, thanks so much. Oliver Crook there with the very latest proposal from the European Union now. Meanwhile, President Trump has also paused all U.S. military aid to Ukraine just days after his Oval Office bust up with President Zelensky. Now, a Defense Department official has told Bloomberg it will not be resumed with the U.S. president until the U.S. president determines that Ukraine's leaders are demonstrating a good faith commitment to peace. Let's get more details from Bloomberg's EMEA News Director, Roz Matheson. Roz, there's been so much to unpack. It's definitely a move, or it seems like it's definitely a move to actually squeeze Zelensky out. How much does this increased pressure change the cards?
It certainly does increase the pressure on him, because we're talking about a very important supply of weapons to Ukraine. We're talking about weapons that are already in Poland, waiting to go over the border into Ukraine, and those that are en route. And these are weapons that Ukraine relies on, not just to defend itself in its own territory, but to hold onto those pockets of Russian territory over in Kursk that it now occupies, and use those potentially as a negotiating tool if they ever get to the table to discuss a deal with Russia. And without those weapons, we're looking at Ukraine running very, very low as soon as the summer, and with the prospect that we're not going to get a deal in a matter of weeks for a ceasefire in Ukraine that could substantially weaken Ukraine's position in the coming months. Russia's seizing the advantage to try and take more territory inside Ukraine, for example, or trying to push Ukrainian soldiers out of their own land. And so it's certainly a big move by the US. Europe cannot make up the difference and cannot do so rapidly, at least. And what does this mean for Zelensky? As you were saying, does this force Zelensky into making a more overt, dare I say, apology to Donald Trump for their blow-up at the White House? Is that what Donald Trump is seeking? Does Zelensky have to do that just in order to try and clear the air a little bit to get things back on track towards this minerals deal? Because that's certainly what the UK, France and other allies are suggesting, that Ukraine needs to help find a way as well back towards this deal to get the ceasefire conversation at least back on track. So the ball is really in Ukraine's court to some extent on that. We know that Zelensky's being very quiet on that front. The idea of having to make a formal apology is probably very anathema to him in this situation, and really, does he feel that he should need to? But just simply in order to clear the air a little bit, it might be the only solution in the near term.
Ross, thank you so much, as always, for a terrific briefing. The EMEA News Director, Ross Matheson. Now, coming up, we'll bring you all of the market reaction to President Trump's tariffs next. We'll be joined by Greg Davies. He's President and Chief Investment Officer at Vanguard. That's coming up, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Well, European stocks ranging from automakers to banks have fallen on concerns that the region could be next to face U.S. tariffs after President Donald Trump imposed levies on Mexico, Canada, and China. Now, joining us now is Greg Davies, President and Chief Investment Officer at Vanguard. Greg, as always, thank you so much for joining us. I mean, it seems that there's so much anxiousness from chief executives, from market participants. First of all, how do you cut through the noise to understand what the fundamentals of the economy are looking like right now?
Well, a big part of it is really thinking about the long term. I mean, yeah, there's a lot of stuff going on right now in terms of news headlines and things of that nature, but what we try to counsel our investors on is to think about what they're investing for. The main thing, many of our investors are focused on their long-term retirement, or they're saving for their kids' college education, or buying a house. So when you think about it from that long-term perspective, the day-to-day noise, we try to tell folks to tune that out because it's very difficult for individual investors to really trade that.
But when you look at the tariffs, so the concern right now in the markets is that we don't have a timeline, we don't know who's next, unclear whether the negotiation will have an endpoint. So how do you trade that?
Yeah, so for our teams, our trading teams, what they try to do, again, is they're trying to focus on where can we add value. And so for us, like in terms of our, internal actively managed fixed income team as an example, they're focusing on areas that they feel like they can add value regardless of what's happening in the marketplace. So yeah, we have this backdrop of a lot of macro uncertainty, but what they focus on is really around security selection, looking at the individual companies within certain sectors, and ultimately trying to decide who are going to be the winners and losers in those individual sectors. But it's more security selection versus making big macro bets, which are very difficult to actually consistently add value with.
Yeah, they are. Greg, are you less worried about inflation than you are about growth in the U.S. right now?
Well, I think it's a combination of both factors. I mean, I think, again, when we think about tariffs and things of that nature, the reality is that tariffs, we're expecting that will have an impact in terms of inflation in the short run. It's still a question of whether or not they're short-term or long-term tariffs, and then also what the currency adjustment mechanism is if there's reciprocal tariffs that happen as well. And then the other component is like the impact it's going to have on economic growth. So you could have a case where, yes, inflation goes up, but you also start to see a slowdown in economic growth, which is not a great scenario for, the health of an economy.
What do you think is priced in right now, on equities, but also bonds?
Well, we think for equities, we think the U.S. equity market is priced for perfection, and we would say the U.S. equity market is actually overvalued by a pretty fair degree. And so what we've been counseling our investors to take a look at is two things. Number one, it's really time to look at what your asset allocation is outside of just U.S. domestic equities, which have had a tremendous run over the last decade. They've outperformed international equities by about 7 percentage points per year for 10 years. And a lot of that has really come from, a third of that has actually come from valuation expansion, which we don't think can last given where we've been. And so we've been counseling investors, number one, diversify into international equities because they're more fairly valued. And the other component is really make sure that you look at how much do you actually have invested in the bond market as well. Because we think that bond market returns over the next decade are going to be in that 5% range, which is pretty comparable to what we're expecting in terms of U.S. equity. So we're telling investors, you could buy bonds, get good diversification, and get a return that's going to be comparable to what we're seeing in the U.S. equity market.
Greg, is the equity market in the U.S. priced to perfection overall, or is it especially the big seven, the mega seven?
Well, the big sevens are absolutely, just priced to absolute perfection, but the overall market is still frothy in our view. So when you look at what current year earnings expectations are for the S&P, it's around 22 times, which is really well above the historical average. And when you think about what's being priced in from an equity risk premium standpoint, it's one thing to get a 22 times price earnings ratio when interest rates were close to zero. But interest rates in the U.S., you're talking about 4.15 on the 10-year, somewhere in that ballpark. It's hard to make the case that equity should be at a 22 multiple when, bond market yields are much higher than they have been over the last 10 years or so.
Does the Fed move this year?
We think the Fed's going to move at the tail end of this year, but a lot is going to be driven by what's going on in the economy, the impact of tariffs on growth and inflation. But we're pricing in potentially 2 rate cuts in the second half of this year.
Greg, how do you find those international equities that are not too exposed to tariffs, or do you look through it and actually buy on the dip?
Well, we try to tell investors, you want a broadly diversified portfolio across sectors, because it's always very difficult for investors to figure out which sector is going to outperform in that moment. And what we try to tell investors, stay focused again on the long-term, manage costs, which you can do very effectively if you buy low-cost funds, but try to get that broad diversification versus trying to figure out, is the technology sector going to continue to outperform, or is it going to be something in consumer cyclicals or whatever the case may be?
In fixed income, anything in Europe that looks attractive right now? Again, the concern is that these are countries that have huge amount of debt, but we're also talking about spending more on defense.
So when we think about fixed income, again, more broadly, what we try to say is that, again, you want to do it in a highly diversified manner. And so what our view is for international bonds, it's very comparable to the U.S. bond market, where rates have risen a fair bit relative to where we were post-COVID and post the pandemic. And so those types of things, we think that, again, bond market returns are going to be somewhere in that neighborhood of about 5%, both in the U.S. market as well as globally. So again, we think it's a great asset class for investors to make sure they have good asset allocation to. And one other thing, many investors, again, because they've been so heavily focused on equities, their portfolios have completely been out of balance. So a 60-40 portfolio now over the last 5 years, because of the growth of the equity market, are now closer to 70-30. So they have a lot more risk in their portfolios.
And yet, one of the things that I hear the most by some of the big titans is they worry that there's going to be a bond auction that suddenly goes sour. So is that a possibility in the medium term, or is that a longer term concern?
Well, I think we definitely have concerns around, the size of budget deficits in the U.S., especially in an environment where economic growth has been pretty strong, and yet we're running, budget deficits close to 7% in the U.S. So yeah, that is a concern. It's not sustainable long term. And then you have debt to GDP ratios that are, about 100% or so, with the growth potentially going up to 170% over the next 20 years. So it needs to be put into control, but it really depends on what happens, in D.C. in terms of is there going to be fiscal discipline or not. But the bond market's going to react depending upon short-term funding needs as well as messaging around fiscal discipline over time.
Greg, thank you so much. Greg Davies, Vanguard President and Chief Investment Officer, stays with me. We'll talk a lot more about other parts of the world. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Welcome back, everyone. We're with Greg Davies, President and Chief Investment Officer at Vanguard. Greg, thanks so much for sticking around. Now, we're having a great conversation about, U.S. equities, the fact that they're overvalued or priced to perfection, and how you think bonds will take a larger, or should take a larger part in anyone's portfolio. What are you seeing in the U.S. economy that really worries you? I know there's been a couple of data points, University of Michigan, maybe consumer, but if it goes south, where do you see it first?
Well, I think a couple of things. Number one, you'll start to see a rise in terms of the unemployment rate. We've looked at U6, which is the underemployment rate, at 7.5%. It's not bad. It's risen from where we were in terms of lows, but the economy overall still feels pretty strong. We've had economic growth last year in the U.S. at about 2.5%. Our expectation for this year is around 2.1%, so clearly a sign of a slowdown. But, again, we think the Fed is basically on hold, at least until the second half of the year, waiting for more economic data to come out to find out if they're truly in restrictive territory or not.
If you believe that U.S. equities are overvalued, when do we see a correction? Will it be a trigger point, or is it going to be like a trickle-down effect?
And that's always the million-dollar question. It's always hard to understand like what the catalyst would be. But then when it happens, like it was clear what it was,
like,
and of course that's what it was. I'd say the thing to be looking out for would be if you saw any catalyst in the U.S. market where you saw interest rates rise dramatically. So if we had some really positive economic data that came out that caused a spike in the 10-year yield, that could be a catalyst to see that equity markets, could take it on the chin at that point in time. But, it's always hard to discern what's going to be the driver. But what we'd say is that just expect much lower returns over the next 10 years in the U.S. equity markets relative to other alternatives, and to diversify away from that to some degree.
What do you do with gold right now?
Gold, what we say to investors is like, look, we try to focus our people on income-producing assets, whether not as bonds or equities. We think there's a role for commodities in a small component in the portfolio, 5 to 10%, but again, in a diversified manner versus picking specific areas within the commodity space to try to get diversification. We've seen a tremendous run in gold. It's been a great investment for people, but we look at it in the context of the broader commodity complex versus looking at gold specifically.
So if you look at a portfolio right now, is the biggest question, how do you protect against inflation?
I think the biggest question is like, how do you make sure that you number one, you control your costs, but the other thing is making sure that you don't have too much exposure to the areas where we've seen tremendous growth, which is, again, heavy tech, large cap growth in the U.S. has had such a tremendous run. And if people don't rebalance their portfolios, they're going to continue to get more and more overweight over time.
But do you think, is that just because of the Trump administration, the fact that there's a belief in the markets that he will take care of them?
Well, I think people have just been really drawn by the whole AI story and what's happening there in terms of, the potential for AI, the needs in terms of chips and all those types of things. And the reality is that, again, when you start to see the valuations of some of these companies, like everything has to go perfectly right. And if they don't, there's a lot of risk to the downside. And again, we try to avoid having investors focus so much on one sector in the economy.
Greg, very quickly, China?
China, we're concerned that economic growth is slowing down pretty substantially. They have a real problem in terms of real estate. The number of unsold houses in China is at record highs, and because there's so much wealth laid in the real estate market in China, it's having a really negative impact in terms of economic growth and consumer sentiment there.
Greg, thank you so much. I could talk to you for hours, but you do have a job to do.
Thank you for having me.
We have also other news. Greg Davies, Vanguard President and Chief Investment Officer. Now, coming up, German auto supply giant Continental tumbles on a challenging outlook in global trade tension. So we'll talk to the company's chief executive. Next, we'll talk trade, we'll talk Germany, we'll talk Europe and defense. This is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive in internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump delivers on his threat to hit Canada and Mexico with sweeping tariffs and doubles an existing charge on China, sparking swift retaliation and plunging the global economy into a deepening trade war. The EU proposes extending 150 billion euros in loans to boost defense spending. President Trump, meanwhile, orders a pause to all military aid to Ukraine. And European stocks slump on concern that the region could be next to face U.S. tariffs. Investors await Trump's speech to Congress for hints on future steps. Now, a couple of the big interviews or big corporate stories that we're watching out for. Eutelsat shares more than triple in 2 days. That's their biggest back-to-back gains ever, on optimism that European leaders pledged to boost military spending will aid the satellite operator. So we look at Eutelsat, we were looking at BAE, we were looking at Thales. I mean, some of these defense stocks, but also some of the stocks that are tied to defense are really flying off the charts. Now, iron ore has declined for the 8th session in a row amid rising trade tensions ahead of China's annual legislative meetings. Now, copper also lower, with top supplier China expected to produce a record amount this year. Let's discuss all of this, the outlook for the mining sector, with John Stanton. He's the chief executive of the FTSE 100 engineering company, Weir Group, that provides technology to make mining more sustainable and more efficient. Now, the company topped earnings expectations last week, recently announcing a deal to acquire Australian software specialist Micromine for £650 million. So thank you, John Stanton, for joining us. John, what are you seeing in the U.S. post the Trump election? There's been a lot of enthusiasm for the mining sector. Now there's a lot of concern that with the mining projects also come tariffs.
Yeah, well, good morning. Thank you, Francine, and thank you very much for having me. Yeah, it's quite interesting times at the moment, isn't it? I would say that generally the outlook for the mining industry globally, but particularly in the U.S., is very positive. And we've seen the impact of Trump's drill, baby, drill strategy. You know, that applies to mining as it does to oil and gas. So we're actually seeing something of an acceleration in project approvals and activity on the ground, which is sort of really encouraging. Of course, tariffs create problems, and I think they inevitably will be inflationary. So what we're doing, and it's a bit of a moving feast at the moment, we've been sort of working through various scenarios over the last few weeks. But we have the ability to move our imports and exports a little bit around our global network to try and avoid or reduce the amount that we're bringing into the US and therefore tariffs. But to the extent that we still have to import, then we will push those tariff charges through to customers, unfortunately. So we did that in the last Trump administration quite successfully and managed to mitigate the effect. Probably going to be a bit harder this time, but we have to work through it.
John, why do you think it's harder? It feels like this time it's more tit for tat, so that it could be a proper trade war.
Yeah, no, there's more of it, right? So, last time it was principally around China. This time it includes Mexico, Canada. So we have trade between Canada and the US, Mexico and the US. So there's more of it. There are more countries involved. And as you say, some tit for tat as well. So I think there's just more complexity for us to work through. But I think by and large, we should be able to do that. But as I say, ultimately, it's going to be seen in prices to our customers and then consumers.
John, I have a question on your recent acquisition of the software company Micromine. How does it fit into your digitalization strategy to, I guess, be different to your competitors?
Well, it's a very exciting acquisition for us, Francine. And stepping back, I think, broadly for industrial companies, I think AI and machine learning is going to be a very, very exciting opportunity for growth in the years ahead. But I think particularly for the mining industry, which has tremendous opportunities to optimize, to become more efficient, to become more sustainable and safer. And that applies to existing mines around the world, but also to the new mines that are being built, because our view is that we all want the new mines to be built with the very latest of technology. And with the acquisition of Micromine, what we're creating is an end-to-end sort of digital software capability that will enable customers to become more efficient, use less energy, use less water, create less waste downstream in tailings, which is a big problem for the global mining industry. And I think what we're creating is something unique. If you look at our peer group across the mining industry, nobody will have quite the end-to-end digital optimization capability, right from exploration through to production in the process plants on the mines around the world. So we're really, really excited that we're going to be creating a segment leader here that nobody else will be able to replicate.
And John, given where you sit, I mean, you really have a 360 view of a lot of your customers. If you look at the segments of the markets that you operate in, which one do you see the most growth in?
Well, I think our largest commodity exposure is copper, and over the long run, driven by energy transition, global demographics, rising living standards. I think that's the metal that is critical. It's always, since the Second World War, copper has grown at sort of global GDP type levels, and I think that probably will continue to be the case if not accelerate. Gold has also been very strong recently, of course, for obvious reasons with the geopolitical background. So our gold mining customers are among the happiest that we've got at the moment. It's been more of a...
When you look at gold, I mean, it's we follow this stuff every day. So because of the levels, do you expect them to stay as high for copper, which is also part of the transition, but also AI and gold? Are you expecting very large, supplies or very large orders in 2025?
Well, we hope so, for sure. So I think our gold mining customers are looking for anything they can do to expand, to increase production, obviously, get more out of the ground, given we're at an all-time high in terms of the gold price. So we see a lot of activity across our global gold customers. Copper, I mean, the price is still relatively high by long-term standards. I think there's probably got more to run in terms of the copper price from here. But it'll be a slower burn. And of course, the other sort of battery metals have been a little bit more volatile if you think about nickel and lithium over the last 12 months. But I think the long-term trend there is also quite positive.
Okay, so good to speak to you. Thank you, John. John Stanton, Chief Executive of Weir Group. Now, European stocks exposed to the escalating global trade war, from banks to car makers, are trading lower, including the auto parts supplier Continental. The German company sees limited profit gain this year amid a muted car market and is also pushing ahead to spin off its automotive unit despite the wider downturn. Now, the company's Chief Executive, Nikolai Setzer, joins us now. Thank you for joining us, sir. How do you see the automotive industry in Europe developing this year, given all of the pressure and concerns coming from tariffs?
So we have been seeing already last year that the markets were declining, particularly in Europe, but partly as well in the North American market. And we expect the same for this year. So basically no tailwind to start with. What the tariffs will put there on top remains to be seen. So we just have this situation starting now, and then we will evaluate the situation and take the appropriate measures.
I know you're still pursuing, of course, the spin-off of your auto unit this year. Where are you at in terms of checklist of what needs to be done, and are you sticking to your original timeline?
Yes, we are well on our way. We are fully on plan. We have now the supervisory and the annual shareholder approval in front of us in April. And once subject of that approval, we will pursue and complete the spin-off in the second half of this year. So this will be independent of the market situation. We have taken already strong actions and measures last year, which is the reason why we could increase our earnings in 2024. We have achieved our yearly targets on group level, and we are aiming to further increase our earnings as well on the automotive side in 2025.
What do you worry about in terms of the spin-off? The market seems to be a little bit unsettled, mainly because of trade. Does that delay or does that add an extra layer of burden for you?
We are used to many layers of burden in the last years after the pandemic, and we took already strong actions before on the production side, on the administration, as well on the R&D side. So we have restructuring efficiency measures on our way to adapt to the new reality. So our markets, many markets were shrinking last year. We expect as well many of those markets shrinking this year. So we have well prepared, we prepared those actions, and the spin-off is independent of that because we are ready for it.
I think you have around 20 production locations in Mexico. There's also now a lot of worry in Europe that President Trump puts extra tariffs on Europe. How do you mitigate some of those concerns?
So we have, since more than a decade, the strategy in the market for the market. So we have heavily invested in the last 10 years in the United States, more than 3 billion euro, more than 14,000 people. In the meantime, we have there, we've built two new tire plants in Clinton, Mississippi, as well in Sumter, South Carolina, and in Texas, new brownfields, a new automotive plant for autonomous mobility. We're producing as well for Aurora going forward. So we have localized where that was value accretive, and we will further pursue this going forward. However, as you described well, we have as well cross-border goods as well from Mexico, Canada, from other areas. So we are doing now two things. The one part is optimizing our supply chain in order to mitigate all impacts. And the second part is talking to our customers, very specific about solutions. How can we solve the situations in which we are currently?
Mr. Setzer, talk to me a little bit about what it means to be made in Germany right now. I know you've downsized or slashed jobs in research and development. Some of the automakers have done the same in Germany in favor of lower cost jurisdictions. Are you optimistic about the German outlook post-elections?
We have addressed this already in the past. What we need is in Germany as well in Europe is a political environment which improves the competitiveness of our industries. We have to reduce the bureaucracy, and we have to further make sure that innovations, and this is what the strength is of Germany as well as from Europe, innovative technology, bring this to scale and bring it early to the market. That's what we stand for, Continental. And we have to further create an environment where we can pursue that and getting stronger. Those are the three items. So innovations, bureaucracy, and competitiveness, which has to be strengthened. And with a change in government, as you mentioned, there's the opportunity to focus on those three items going forward.
The EU also said this week that it would grant car makers a 3-year window to hit carbon dioxide emission targets, I think that were originally set for this year. How does that change your order book?
Since the carve-out on the spin-off of our powertrain business in 2021, we are as a company basically powertrain agnostic. So there's no influence which powertrain is built in a car. However, of course, where we have sourcing and some platforms are shifted or changed, this has an effect on us. But basically, it does not change our order book, and we are going forward and plan with that.
Thank you so much for joining us, Nikolai Setzer, the chief executive of Continental. Now, coming up, the UAE's leading oil company makes a new push into chemicals with a deal worth more than $60 billion. We'll get the details next from Khalid Salmin, ADNOC's downstream chief executive. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
There is this real momentum from Wall Street. We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Propose to activate the National Escape Clause of the Stability and Growth Pact. This will allow member states to significantly increase their defense expenditures without triggering the excessive deficit procedure. So if member states would increase their defense spending by 1.5% of GDP on average, this could create fiscal space of close to 650 billion euros over a period of 4 years. The second proposal will be a new instrument. It will provide 150 billion euros of loans to member states for defense investment. This is about basically spending better and spending together.
European Commission President Ursula von der Leyen there. Now, this is a picture for defense stocks. They have been really, literally flying off the roof in the last couple of days as Europe is talking about pushing their defense a little bit up. Now, intraday, it's not as impressive, of course, as it was yesterday. BAE System yesterday, I think, was about 9% higher now, gaining some 0.5%, or 0.5%. Dassault Aviation gaining 4.3%. Coming up, our interview with Khalid Salmin, ADNOC's downstream chief executive, as the UAE's leading oil company makes a new push into chemicals. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology
technology is driving business across Europe.
Companies in Asia are betting on tech.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back, everyone. Now, ADNOC, the Abu Dhabi National Oil Company, and Austrian energy company OMV have agreed a deal to create a global chemicals giant worth more than $60 billion. Now, the agreement caps almost 2 years of negotiations. It's ADNOC's latest big push into chemicals after it agreed to buy Germany's Covestro last year. Now, we're now joined by ADNOC's downstream chief executive, Khalid Salmin. Khalid, thank you so much, as always, to give us a little bit of your busy schedule. Now, talk us through how ADNOC will combine and actually coordinate this new chemicals holding to maximize growth.
Thank you, Francine, for hosting me again. Clearly, today we are here to celebrate the creation of a global giant in the petrochemical space, and that is Borouge Group International, a $60 billion plus polyolefins company that has a global footprint again. North American assets, European assets, as well as Asian assets to serve our customers. So clearly, this is a deal that has been not only a merger, as we were discussing, and has been about the merger of Borouge and Borealis, but as we are going through this, we are also acquiring Nova. The funny story is that 25 years ago, I started as a young engineer. At that time, in 1998, Borealis and ADNOC signed the first joint venture to create Borouge. At that time, we're talking about 450,000 tons. Today, with this deal, upon completion and the regulatory approvals, we would be at 13.4 million tons and puts us at the second largest outside China, fourth largest worldwide, and that is about 30 times bigger than when we started. So we're very proud.
It's impressive. Yeah, I mean, it's an impressive number, and it's very clear that you want to go big or go home, and that you're trying to do a real world-class leader. When you look at what you have now and where you want to grow, do you still have any holes to fill?
Clearly, in the polyolefin space has been one of the key focuses. Our long-term mega trends is that polyolefins will continue to serve customers. It has the right technology, and it has the right cost base. So today, with the creations of Borouge Group International, we're able to serve our customers from first-class assets or first quartile and world-class assets in markets, i.e. in the different regions. And given that logistics cost is a significant part of delivery, as well as the differentiation at scale is one of our key strategies, we believe that this merger and new acquisition of Nova allows us to be at the forefront of serving our customers for years to come.
So after the Nova Chemicals deal is complete, are there any other types of M&A that you'd be looking at, or will you pause?
Clearly, we will continue to look at growth. We have Borouge 4, which is also under construction. It's a world-class asset as well. I think what is really important is now to focus on delivering the synergies and delivering the one company, one culture. That being said, there is still regulatory approval, and upon completion, we see that asset moving into XRG. So it's a part of our global chemicals platform, which we have embarked on. So we are very excited, and we're very delighted that we're able to reach this agreement here in Vienna.
I mean, longer term, how many more, or do you want to build more chemical plants, actually? And if so, where?
I think that really depends. I mean, chemicals is a cyclical business. So really what is important is that you keep monitoring the market. You have the right technology to be able to differentiate your products. You have the right cost base with the world-class assets. And then you see how the market develops. And clearly, with the different plants in different regions, we would be able to optimize our portfolio between product mixes, customer demands, and grades to be able to meet these customer demands in market. And that's really the global strategy we have around chemicals.
If you look at, of course, looking at the Nova acquisition combined with the Borealis assets, it will give this new joint venture a big presence in the U.S. Gulf Coast. How much will North America actually figure into the new company's growth plans?
So when we look at this global company, clearly there are arbitrages between the North American pricing, the American or the European pricing, and the Asian pricing. The way we look at it is through the cycle, and through the cycle, we see this as a $7 billion EBITDA group, which is really a significant group. Again, depending on how the market develops, we will see where the investments will need to happen. This platform gives us key technologies between AST of Nova and Borstar of Borealis. And with these two differentiating technologies, we are meeting a lot of the spectrum of specialties, which has been our focus around chemicals. So we're very excited about the next chapter, which is making sure that we go through the regulatory approval as swiftly as we can, but at the same time, completing that one culture, one company approach and delivering that value of synergies, which is really around 500 million a year. And that comes mostly from synergies around revenue. So that's really a positive story because of the ability to optimize your CapEx and grade mixes and logistics to serve customers. So we're really excited about this period, and getting this deal done has been, one that we've worked on for a while now.
I know you already have deals for LNG offtake. Would ADNOC like to buy some of the U.S. natural gas production?
So I think that fits within the XRG space. Obviously, in XRG, we have three pillars that we are focused on. International gas, and we've been working on deals. We've done 4 deals there. Global chemicals, and you've seen the Covestro deal, as well as the Group Route International. And obviously low carbon, and we continue, and that was the Fertiglobe deal. So XRG continues to move forward. We are very happy with that progress. Global chemicals right now was the right time. There is a period on which the chemical cycle was, the appetite for doing deals is there. That recovery we see already, so we are beyond the bottom of the cycle. And it is really important that as you go through the peak of that cycle, that you are able to optimize and synergize your portfolio. And that will be the real focus over the next coming period.
So interesting. Thank you so much for joining us today. Khaled Salminder, the ADNOC Downstream Chief Executive. Now, a couple of other things we need to make you aware of. The Hungarian forint gaining after a Bloomberg report saying the country's new central bank leadership sees no room to cut interest rates because of a resurgence of inflation. Up next, Bloomberg Brief, Danny Berger, Manus Cranny in New York, and this is Bloomberg.
First time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers, and 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Bringing you up-to-the-minute global financial news whenever and wherever it happens. I'm Jonathan Ferro.
And I'm Lisa Abramowitz in Davos, Switzerland, and this is Bloomberg.
Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Tariffs go live. President Trump delivers on his threat. Canada and China retaliate. Stocks post their worst day of 2025. Oil falls and spread widens as growth fears mount. Turning up the heat on Zelensky, President Trump pauses all U.S. military aid to Ukraine. Europe readies up to 800 billion euros of defense spending. Good morning, Manus.
Danny, good morning. That's what you call building the defense dam. Stocks are just trying to calibrate themselves. We've dropped by 1.76% yesterday on SPOOs. The Nasdaq down by 2.64%. We are live. The VIX is the highest since 2025. And this volatility, let's see where it goes. There's no room left. $900 billion worth of imports from Canada and Mexico with a 25% tag on them. China, pretty measured response. We'll talk about that in a moment. We're in an air pocket of activity, according to JP Morgan, and oil down for the third day. Danny, down 4% over 3 days as OPEC readies itself to add more barrels in the eye of potentially a growth slowdown. The bond market year-to-date lows. There's a whiff of stagflation. One could say the growth bears are in charge here. Just look at that ISM data yesterday. The new orders, the biggest one-month drop in 5 years. So we're just seeing a steadiness on these yields, but the low for the year in the U.S. Down.
Now pricing in 75 basis points of cuts for the year. Man, some individual stocks that we are also keeping our eye on this morning. TSMC, that seems to be continuing its rally this morning. Let's get a check on those prices. It is up 1 1/3% in the pre-market. It announced plans to invest an additional $100 billion in U.S. plants. It will boost chip output in the U.S. and support President Trump's goal of increasing domestic manufacturing.
Otco shares jump after the infrastructure software company reported its earnings. They were stronger than the forecast, Danny, up 16% and change.
Also, Walgreens, that is also higher in the pre-market trade by nearly 6%. It's up on reports that Sycamore Partners is nearing a deal to buy the drugstore operator, taking it private, and that could lead to its breakup and end a tumultuous run as a public company.
And in just a few moments, we have Mark Haefele from UBS. He'll join us, and then Stephanie Roth from Wolfe Research a little bit later in the hour, dissecting these live tariffs that we are in. President Trump follows through on his threat to impose additional tariffs on Canada, Mexico, and China, sparking a tit-for-tat. Beijing slapped levies on the U.S. goods. Canada responded with a sweeping package of counter-tariffs targeting American cars, trucks, steel, and aluminium. Brendan Murray, who heads our global trade coverage, joins us now. So here we are. We are live, $900 billion on Canada and Mexico. We've had the Canadian response. Just frame this for us, Brendan, in terms of the scope of what is covered and the response and the risk.
Yeah, so we haven't heard from Mexico yet, but they've held their cards a little more closely to the vest. But undoubtedly, we will see a retaliation from Mexico, if not today, then very soon. So what we have is a situation that we haven't faced in a long time: a big regional trade war among traditional trade allies. So as you said, this is a total of $1.5 trillion worth of goods that flow across these two borders. It's on the magnitude of 5 times bigger than the amount of goods that were tariffed during Trump's first term, something like $300 or $400 billion worth of Chinese imports. So the real question now is how much pain economically will be created before the dividends that Trump thinks will be paid on these tariffs will be seen. The price of consumer goods may not take that long to show up at the grocery store and the drugstore and the consumer electronics store and the auto showroom. So we're looking at industries that have to some extent anticipated these tariffs, but eventually those padded stockpiles will run down, and they're going to start paying that extra 25% tariff for Canada and Mexico and 20% on China, and start saying, I've got to raise my prices. That's what a lot of economists are saying in their research notes this morning, and that's how we'll have to see the market reaction to whether that hurts companies' bottom line as well.
But I guess we can call this round 2 of tariffs, since we already had 10% on China, and now we have this. What's next in the tariff timeline? What else are we expecting from the White House?
Well, the president has laid out a number of additional tariffs. We have steel, 25% tariff on all steel and aluminum imports. That comes next week, so March 12th. Then by April 2nd, he's put a number of other threats on the table, the tariffs on pharmaceuticals and lumber and a number of other products, chips and cars. So there's a whole host of other tariffs that are coming down the pipeline, and many of them will be used for negotiation to drive the parties to the negotiating table. But as we've seen over the past 24 hours, some of those threats are being turned into reality.
Brendan, a fast-moving story. Thank you for helping us keep track of it. That is Bloomberg's Brendan Murray. Risk reaction yesterday was swift. We saw the S&P 500 post its worst single-day drop of the year, erasing gains for the year, now down 0.5%. These were the worst performing sectors. The worst of it all was information technology, down 3.5%, followed by energy, consumer discretionary, and materials. Joining us now is Mark Haefele, CIO of UBS Global Wealth Management. Mark, I'm sure you've been a very busy man, fielding phone calls left and right, so thank you for making time for us this morning. The reaction wasn't one of sell the importer specifically. It was risk. It was all risk getting sold, and things like information technology, the big technology stocks, NVIDIA getting hurt specifically hard. I wonder what you make of the market reaction, whether it was logical, and how it evolves from here.
Yeah, you're right. It's been busy. I think that one of the things we highlighted last week when we came out with our monthly update is, for a variety of reasons, we're entering a period of heightened volatility and uncertainty stemming from a lot of policy. So, of course, first is the potential for a government shutdown. And then, as noted, we have a lot of tariff news coming out, especially when we get to April 2nd, where the government releases a lot more data on all the countries that have wronged the United States on the tariff front. So while the overall picture for the economy and our base case, we still think that the U.S. economy is strong, sustained tariffs, particularly on Canada and Mexico, will start to bring down growth forecasts, but also kind of hamstring the Fed, because they don't know what the inflation outlook would be. So I think that's why certainly, sentiment wasn't great last week. It's not going to improve with these increased uncertainties this week.
Mark, good morning to you. I like what you say, which is it's very used. Stay grounded in the data, separate rhetoric from reality, and diversion of direction. The data is slipping, Mark. whether you like seasonality or not, Atlanta GDP, the new orders yesterday, and the ISM and consumer confidence. There is slippage. What does that translate for you to risk?
Yeah, well, look, a lot of that data is survey data. You know, the S&P 500 earnings were very strong. And of course, you know, what are they going to do forward? And some of that sentiment data matters. But I think that we're really going to have to look at what's going on with jobs on Friday and continue to follow this. If this slowdown from the great consumer spending that we saw and the strong performance into the end of the year, you know, how much this is just a kind of a dip, or this is just eventually so much uncertainty and so much disruption around trade starts to bleed into growth and also potentially inflation.
Mark, you make a great point, and Bank of America just put out their earnings sum that we're up 15% year over year for the fourth quarter. That is the strongest quarter since the fourth quarter of 2021. So earnings have been remarkable. But all you need to do is look at what some of these manufacturing companies were saying in the ISM survey that Manus has been talking about. Over and over again, they talk about the inability to do business because of the uncertainty of what tariffs look like. Is there a period where there are scars left on companies, Mark, from this, of uncertainty, if you're a manufacturing company, what you do, or just in general, the amount of CapEx or deals you can make in this environment?
Look, it certainly feels that way, right? Because the Trump administration's agenda has both a business-friendly, pro-growth side to it, but also has a cutting spending and a potential inflationary side. And it does seem that they've kind of front-loaded the cuts and the uncertainty rather than the pro-growth side. So if this continues, if you know, the tariffs start to stay on with, and this isn't just negotiation, then I think a lot of the people who are betting on a Trump put are going to start to really question that. So we're in a challenging period. I think there were signs we knew this would be a challenging period, but it's here and it doesn't feel good.
What do you think the Trump put is this time around? Trump 1 was about stocks. We're just showing the performance, testing the Trump put on the S&P 500 since inauguration. It's hardly horrendous, and some say maybe the Trump put this time is the 10-year yield, which is down and continuing lower, Mark.
Well, you know, speculating on what goes on in Donald Trump's mind is not something that I do. I do it very reluctantly, and we don't know. I mean, I think we do have certainly the words of Treasury Secretary Bessent about the focus on the 10-year yields. I wouldn't focus so much on levels, but their mindfulness that both the inflation picture and the growth picture go into that, and they need to manage both of those things. And then, of course, you know, to be a business-friendly president and to see, say, the S&P 500 fall below where it was when he was inaugurated, there will be a lot of press on that.
Of course.
Let's just put it that way.
Look,
Yeah.
and you're right. We're trying to speculate the inner workings of the president's mind, and that's a fool's job. Risk was disrupted yesterday. Credit, oil, stocks, Bitcoin, the whole plethora was disrupted. I know that you like investment-grade bonds. I know that you like gold. But when you look at credit spreads, they popped to the widest since of October last year. When you see disruptions like that, is that an opportunity to take corporate risk because you look through the disruption?
Well, I think that you know, the fixed income portfolio, the focus on quality, that's really there as a portfolio stabilizer. I think where we would start to look, and it might be a little too early, is on some of the broader themes we like in equities, like power generation, and like things around AI. So because we still think both of those are going to continue to benefit from the global build out of AI. Which is going to go forward. You know, we can debate about the near-term growth rate on that, but those are the places where we would be most focused on looking to buy the dips.
Okay, long live AI. Mark, thank you very much. Mark Haefele there of UBS setting the agenda this morning on Bloomberg Brief.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Brief. I'm Manus Cranley alongside Danny Berger right here in New York. Well, President Trump has ordered the pause of all military aid from the U.S. to Ukraine. The move stops weapons in transit to the country at war and freezes billions of dollars of payments that were scheduled. The move turns up the heat on Ukraine's president, who has to demonstrate a commitment to peace to earn back this support. Let's bring in our EMEA News Director, Ros Matheson. Ros, the scale. I want to understand the scale of what has been halted in terms of forward military aid, and what is a demonstration of good faith?
Well, it's potentially very significant what's been halted because Ukraine relies very heavily on the US for military aid. That's aid that's both currently en route, by the way, to Ukraine. It's aid that's sitting in Poland ready to be transited into Ukraine, and it's further commitments of aid going forward because under the Biden administration, they front-ran a lot of military aid into Ukraine for this reason, out of concern that things would slow under Donald Trump. And here we are now at an actual pause in military aid. And that means that Ukraine's at risk of running very low on weapons as soon as the summer. We're talking about tanks, armored vehicles, munitions, everything, including ammunition, but also those long-range missiles have been very useful for Ukraine, both to defend its skies against Russia, but also to push its own troops into Russian territory under air cover. And those troops are still in the Kursk region of Russia. And that's a potentially significant bargaining chip for Zelensky in any conversation with Russia. And so if they have to pull back, obviously, that's a weakening for Ukraine. So we are talking about quite a significant impact on the war on the ground, and pretty quickly.
And Europe's waking up to the reality that they are perhaps at it alone. European Commission President Ursula von der Leyen was speaking about an hour ago saying that the loans for defense spending could total something like 800 billion euros. Roz, let's just take a listen to what the president had to say.
We are in an era of rearmament. And Europe is ready to massively boost its defense spending, both to respond to the short-term urgency to act and to support Ukraine, but also to address the long-term need to take on more responsibility for our own European security.
Roz, can you just put in context the level of spending that we're hearing about from the Europeans?
Well, that's right. As you heard, we heard Ursula von der Leyen talking about spending hundreds and hundreds of billions of dollars on defense, which sounds like a lot, but there's a lot of steps that have to come before any of that money really sees the light of day. For a start, we have to have this discussed in greater detail and then presented to leaders of the EU, possibly towards the end part of March. But with a lot of caveats, because countries like Hungary have indicated they don't support this. Other countries already expressing reservations about having to find extra money for defence spending at a time their economies are already in a pretty fiscal tight spot, and they're taking money from other areas of their economies to do so. So this is no slam dunk for the EU. And even if these packages get sign off and we start to talk about increasing defence spending, that's something that's going to come over a period of many years. This is about future-proofing Europe in a way in its defence. It's not about immediate change you're going to see in the next couple of months. And that may not be fast enough for Donald Trump, who's very keen for Europe to show very tangibly that it's doing more to spend on its own defence.
Donald Trump certainly not waiting for others. Roz, thank you very much. Bloomberg's Roz Matheson. And on that point, now that we have 20% tariffs in effect for China, China has been announcing retaliatory measures. Here is the latest. China is halting imports of logs from U.S. companies, from some of them, and soybeans. This is specifically from 3 different firms. China already announced today that it would also impose additional tariffs of up to 15% on some U.S. goods starting on March 10th. So again, this is halting the imports of logs and soybeans from 3 U.S. firms. We'll have more coming up on your Bloomberg Brief.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice, my conversation, my poetry, you know.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
Aramco is planning to cut the world's biggest dividend. The move could affect Saudi Arabia's budget, which relies heavily on Aramco's dividend payouts. Let's bring in Bloomberg's Jomana Bersetchi in Dubai. Jomana, great to see you this morning. What brought us to this place?
Yeah, hi guys. So Aramco earnings came out a little bit earlier. Operating profit down 11% year on year, pretty much in line with analyst expectations. The view was that they would actually see a drop in both revenue and in profit this year because of, one, lower oil prices, but of course lower production as well, with Saudi Arabia producing sub 9 million barrels a day, away from their full potential. So there's still a lot of spare capacity there. But I would say that the big focus for the investment community was on that dividend and the guidance that they've given for this year. They have said that they expect the total payout for 2025 to come in at $85 billion. That compares to the $124 billion that was paid out last year. Now, you will remember that they started paying out this performance-linked dividend. You've got a base dividend and then a performance-linked dividend after the major windfalls that came through following on from the oil price spike in 2022. And since that point, they have honored those dividends. But towards the end of the year, the financials started to become a little bit not sustainable because they paid out more in dividends than the free cash flow that they were generating. So the expectation from the analyst community was that they would have to do something about the guidance of that dividend in 2025. So it's come through this morning, but also it is of particular interest because, as you know, about 97% of the Aramco stake is held by the government, either directly or via the PIF. And so it is an important source of revenue for the government at a time when, of course, the Saudi Arabian government is spending a lot. But what it really encapsulates as far as Aramco are concerned is that, number one, they are very much still focused on the financials of the company and have had to do a reevaluation of the size of the dividend that's paid out. And number two, despite those linkages to the government, they've decided to do a mark-to-market of the dividend payout that is feasible.
Jumana, very briefly, we see OPEC taking action to add back barrels. Is that political pressure? What's going on within OPEC? Because it's an interesting move.
Yeah, it is. And many in the analyst community thought that the OPEC Plus group would once again postpone the decision to put extra oil barrels back to the market from that April deadline. But they haven't. They announced yesterday that they are going to proceed as planned. You will start to see a gradual increase of oil barrels coming back to the market, the tune of about 160,000 barrels a day. On the back of that, we have seen some downward pressure on energy prices. But to go back to the CEO of Aramco today, they think that oil demand is going to be very strong this year.
Okay, well, certainly it's on the back foot. We're at a 3-month low, and output is rising to a 1-year high. Jumana, thank you very much for covering the oil stories from Dubai. Jumana Busechi there. More breaking news on tariffs in just a moment from Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny. Let's set your agenda.
Tariffs go live. President Trump delivers on his threat. Canada and China retaliate. Stocks post their worst day of 2025. Oil falls. Spreads widen as growth fears mount. And Trump turning up the heat on Zelensky. The president pauses all U.S. military aid to Ukraine. Europe readies itself with an 800 billion euro defense spending.
Well, yesterday was a tough day, Manus. We'll see what today brings, but it started with ISM manufacturing showing new orders falling into contraction. Then the room for negotiations ends, the tariffs go live, and we have our worst day of 2025. We add some weight to that sell-off this morning, down about 1/10 of 1% rather, for the S&P 500. Russell 2000, those underperform. Will we get another bad day? Mag 7 now down more than 10% in the past 2 weeks. Nvidia down 15%. Year to date. Now for this bond market, trading almost as if it is a growth shock and perhaps an inflation scare. A full 75 basis points are now priced in by the December meeting. Your 2-year yield, that gets a bid. Again, that assumption that we will get more cuts coming from the Fed. We are at 3.92%. Your 4-year yield and 30-year yield, little change this morning, 4.1% for your 10-year yield, Manus.
And that's the difficult balance for the Fed, Danny, isn't it? That whiff, as Mohamed El-Arian said yesterday, and other notes have said it, that whiff of inflation, when does the whiff of stagflation, when does the whiff of stagflation turn into a bit of a stink in terms of the growth versus inflation? And that's the balancing act for them. Do they lean more into the growth slowdown relative to the inflation?
Well, it's hard to kind of gauge whether what we're seeing now truly is a growth scare. A lot of people point to the fact that it's a lot of sentiment surveys, not necessarily hard data. You are seeing, though, more executives start to talking about this idea that it could be a recession. Goldman Sachs' David Solomon yesterday saying there's a very small chance that the economy tips into recession. Barclays also yesterday writing a recession in the U.S. remains improbable, but it is no longer unthinkable.
And this adds into Torsten Slok. It's sort of a mini growth slowdown, but it is, in his view, not a recession. We've had some breaking headlines over the past 30 minutes, if you're just tuning in. More reciprocal tariffs coming from China, halting the imports of logs, soybeans, again, going back to Trump 1, and we talked about this. So there's incremental but calibrated response from China at this stage.
Well, that's what makes it so hard to understand what the fallout is, because it's not just what sort of tariffs and how long will tariffs be put on from Trump, but what the retaliatory measures look like.
Well, let's talk about those. Investors are bracing for the economic fallout from these tariffs. Stephanie Roth is the chief economist at Wolf Research. Good morning. Good to see you.
Good morning.
You know, there's just headline whiplash every day. When you look at the policy mix, and the three of us were just talking about this is a fairly toxic bag of policy that you're dealing with at the moment. Is this kind of the worst case scenario, or is it how long did these tariffs endure for? How do I read this?
The combination of the policy mix probably couldn't get worse at this point. Of course, things could always get worse. But if you were to define something that's really quite negative for the economy, this is it. We have government layoffs, the private sector is getting squeezed, we have these massive tariffs, which by our estimates, that could shave about 1 percentage point off the U.S. economy. And the fallout could be pretty significant. Our base case at this point is the tariffs won't last that long, just because they don't really make that much sense in the first place. We're tying these to fentanyl trafficking and migrants, right? And the fentanyl from Canada is largely non-existent. The flows are incredibly small. And from Mexico, they've made significant improvement. So base case at this point, and I think that's what the market is suggesting too, is they don't expect them to be lasting. Otherwise, you would expect to see a much more significant hit from the market today. Down 10 basis points on the S&P, that's not all that significant considering the extent of the potential economic damage from all of this.
I mean, to be fair though, most people thought we wouldn't even get to this place. And I wonder, Stephanie, even if this doesn't last that long, even if it's a week of tariffs put on and then there's some sort of backtracking, I asked this to Mark Hafley of UBS earlier, but are there not scars that are left of companies that realize that uncertainty of the environment that they're in, you get less CapEx, you get less spending, you get less deals, that something continues to creep on even if the tariffs are taken away?
Yeah, I think that's fair. You'll have a little bit of a headwind on CapEx this year. It's hard to make investments if you have no idea what the tariff rate's going to be and whether you can pass that on. So I think that's fair, but at the same time, the economic damage would be significantly limited if we do, in fact, remove them in just a matter of a couple of weeks.
When you look at the data, and again, Mark had this to say, look at the data, stay steady. You look at some of this at the moment. The Atlanta Fed GDP swings to negative 1.5% negative. New orders, the biggest one-month drop in nearly 5 years. Inflation expectations are rising. Again, that's a fairly toxic mix. Is that short term, and you think that will pass through and we will recover?
So it's interesting. I mean, the economic data so far have been okay in terms of hard data, right? The economy so far
This is soft survey data.
Right, this is soft survey data. The Atlanta Fed is significantly impacted by imports. Imports are because we're buying ahead of tariffs. That will go into inventories. So as of now, we're tracking Q1 GDP something around 1%. So not good, but not massively negative. If these tariffs, in fact, stay on place, then we're talking about a real significant slowdown for the rest of the year. But as of now, at least, the data are okay. Sentiment surveys are telling you that people are scared about the tariffs, and that's fair. They should be.
Yeah, I mean, to be fair, Atlanta Fed now falling to 2.8%, but the S&P's tracker is up 1.6%. So there definitely, to your point, are some differences there. Neil Dutta of Macro Research talking about this idea of a feedback loop, that you have growth slowing and you have a Fed in wait-and-see mode because of tariffs. So either someone needs to blink first, it needs to be a Fed that cuts, or Trump that takes back tariffs. Do you see that same sort of feedback loop happening, that the Fed is kind of stuck, that you don't think that they're going to take action necessarily until they understand what the ramifications of tariffs are, and that by that point it might be too late?
The Fed's going to have to react to the data, right? At this point, payroll should be okay. We're looking for 180,000 this week on non-farm payrolls. The Fed's not going to be able to start cutting rates unless they have significant financial market weakening, which so far that's not necessarily the case, and bond yields have come down as a result. Or we start to see a rising unemployment rate. And the policies, while they're bad, while sentiment is bad, they haven't had a real impact on the U.S. economy at this point.
But then here's the issue when it comes to this Tier 1 data, which is what the jobs data is. Is this the sort of the last significant good innings that you have before some kind of bleed effect from DOGE and other actions?
Well, I think that the Fed's going to look through at least the government numbers. They're going to probably be looking at private payrolls in the next couple of prints, knowing that DOGE is having an impact, and it's not for economic reasons. But if you start to see that bleed into the private sector, then that's where it becomes important, and then you'll see who's going to blink first.
In terms of the impact of the markets and what that tightening does, there was a study from Moody's that got some attention earlier this week, that it was the top 10% of wealth in America, of those consumers, account for 50% of U.S. consumer spending. If there is real significant weakening in the markets, of the likes we've seen, again, it's not horrible yet, but if we continue to get that, is the economic ramification of it worse this time around just because of that concentration of consumer spending?
Yeah, I think that's fair to some extent. The above-trend consumer spending was in part driven by this wealth effect, combination of equities and housing net worth. Now you pull the rug under that under the rug of the consumer, that's particularly at the high end, that's been spending above their typical savings rate. I think that's fair. You'll probably see a significant slowdown from that perspective. Granted, like you said, we're just back to where we were a couple months ago in the market. I think you're going to have to see much more material weakening from that perspective. Something like a 15+% sell-off in the S&P, and we're not there yet.
And at that level, and again, this goes back to the debate, is what is the Trump put? Mark Hafley didn't want to go inside the mind, obviously, of President Trump. But we really haven't seen a significant equity drawdown yet. We've seen a few jolts in the Mag 7, but we've not seen anything catastrophic yet that would invoke a sort of a pullback from the Trump administration.
No, we haven't, and we don't really know where that Trump put is, but I do think it's notably lower than where we are today.
I mean, is there just this whole sense, though, that we're maybe underestimating the ramifications of this? Again, I go back to the idea that we thought these wouldn't be put in place. To your point, they don't really make sense. How concerned are you that we don't really have a full grasp of just how far Donald Trump will go?
Yeah, I think that's concerning. I mean, I haven't incorporated these numbers that materially into my outlook. If I were to take a 1 percentage point hit to my growth numbers, that outlook's going to look quite a bit different for this year.
How important, let's square off on this. How important is going to address joint sessions today? How important is it that this one big, beautiful deal goes through, that the tax bill actually gets done earlier in the year, not at the back end of the year? How important is that?
I mean, I think it's somewhat important. I mean, the most important thing is that it gets done, right? If we start to see a tax hike on the consumer for next year, then you're in real big trouble. But base case is this will probably get pushed into sort of towards later this year anyway.
Yeah, as we had talked about heading into this year, that the sequencing is so important, and unfortunately, it's been basically all of the bad stuff for Stephanie. It is so wonderful to have you on. Thanks for waking up early and joining us. That is Stephanie Roth of Wolfe Research. Let's now get you some other top stories that are trending on the terminal this morning. We mentioned this one. Goldman Sachs CEO David Solomon sees, quote, a very small chance of the U.S. economy entering a recession. That's despite the uncertainty surrounding global trade policy. Speaking in Sydney, Solomon said that President Trump is acting on the view that imbalances exist in trade.
Aberdeen abandons its 2021 rebrand, renames itself as the Aberdeen Group. The asset manager has been contending with ongoing outflows. That's less than 4 years ago. The company dropped most vowels from its name in a radical rebrand. It now wants to remove, quote, distractions.
Great, vowels are back.
I got it there. In the end, I got the vowels.
All right. Well, this one's quite unfortunate for Citi. Another multi-billion-dollar error at Citi. To be fair, the last one was a multi-trillion-dollar error. But according to sources, its wealth management business almost shifted about $6 billion to a customer's account by mistake. That's after a staffer handling the transfer accidentally copied and pasted the account number into the field for the dollar figure. And I ask Manus, why am I never at the receiving end of these errors from Citibank?
I would be so happy even just to skim the interest off the top of that in an overnight payment. I don't need the bulk payment. I just need the interest off the top.
Citi, you've heard it here first. Manus will send you his account number. He's happy.
I'd return it all. I would.
All right, on to serious matters. Coming up, we're going to talk about tariffs. President Trump follows through on the threat. We're going to have more of that next on Your Brief.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It is Bloomberg Brief. I'm Manus Cranny alongside Danny Berger here in New York. Well, tariffs are in effect. President Trump follows through on his threat of 25% for Canada and Mexico and doubles the levy on China. The retaliation has firmly begun. Canada responded with a sweeping package of counter tariffs targeting American cars, trucks, steel, and aluminum.
Meanwhile, we're learning this moments ago that China is halting imports of logs from the U.S. as well as soybean imports, specifically from 3 U.S. companies. Bloomberg's Enda Curran joins us now from Washington, D.C. And it's so much to sort through. Can you just kind of give us stock of where we stand at this moment?
So as of this morning, we now have tariffs covering 1.5 trillion worth of goods imposed overnight. That brings the tariff level to its highest since about 1943, according to one estimate by the Yale Budget Lab. And we're talking about tariffs on all goods coming out of China, not just intermediate components or national security-related products. It's across the board. And likewise on Mexico and Canada, with the exception of energy coming out of Canada, which will be tariffed at 10%. So it's obviously a very sizable development. It moves this trade war to the next level. It starts something of a global trade war because we're seeing the tit-for-tat now, the responses from Canada with immediate retaliation on tariffs worth of 20-odd billion US worth of goods. China, of course, responding with 15% tariffs, as you mentioned there, on agricultural products like soybean and the like. We'll probably get the Mexico response later this morning. President Sheinbaum expected to speak to reporters there. But taken all together, we've gone past now the kind of threatening phase to this new level of sweeping tariffs on goods between these major trading partners.
And we had that news alert, and a good morning to you, from the EU warning that transatlantic economic stability is threatened. Let's dig a little bit deeper into the China response. As Danny said, it's soybeans and logs in addition to the agriculture, but it's a calibrated, or people are assessing the China response as being quite measured and calibrated. Is that because Xi has a pretty critical NPC meeting this week?
Yeah, that's the immediate takeaway. So China has, of course, been quick to respond, 15%. Obviously on strategic areas like farming, trying to make the point that we can inflict pain on the US too, and you know, targeting those GOP-sensitive electoral bases. But to your point, Manus, there is a view that it is, at the same time, somewhat measured. The government in China does have its big economic policy planning meeting this week, the National People's Congress. That's where they're going to agree on how much money they need to put into the economy, how much support to put into the economy. And then, of course, don't forget, this is only one part of the sequence of tariffs when it comes to China, because in early April, we're expected to get those reports back from the trade representative to the White House in terms of how the US is trading with China, how did the trade one deal with China play out, how does China protect US IP, and so on and so forth. And that's expected to lead to the next round of tariffs on Chinese goods, including sectoral tariffs, at which point negotiation may or may not kick in between the two governments. Presidents Trump and Xi have not had a call, actually, since President Trump took office. So, on the one hand, yes, somewhat measured by China, but worth remembering this is only one part of the sequence. More US tariffs on Chinese goods are expected maybe in early April. And then the big question becomes, are they going to start negotiating with each other or not?
Well, we're going to hear from the president tonight. He's going to be addressing a joint session of Congress for the first time in 5 years since he was last president. He posted on Truth Social last night saying, tomorrow night will be big. I will tell it like it is. And what are we expecting from the president tonight?
Well, a theme of renewal is what President Trump is expected to push, and it really covered a spectrum of issues. I mean, the first 6 weeks of the new president's term have been passing by at a frantic pace, Danny, as you know. Major developments on foreign policy, on security policy, on domestic economic policy, on taxation policy. So we're expected to hear rationale and reasoning behind the ongoing spending cuts, the efforts of DOGE. He wants to make sure that lawmakers are behind him on those measures. Get some signals from him on the tax package and the progress of that. Get some signals from him, of course, on broader trade policy in terms of where he's going to bring it next and how serious it is. And, of course,
we'll get an update on his thinking on where he's going with national security and foreign policy too. Plenty of analysts are making the point it will be interesting to hear how much he adheres to the kind of messages that President Trump pushed himself on the campaign versus how much he adheres to some of the messaging that were pushed by, for example, Project 2025, which has also played an influential role. So it's expected to be a sweeping take on the kind of policies the President expects to roll out in his term, and also a kind of an effort to get lawmakers behind him and make sure that they're all rowing in the same direction.
Okay, Enda, thank you so much. Enda Karen tracking the very latest on the tariffs, and let's focus on the President later on today when he speaks to the joint sessions of Congress. And President Trump, he also orders a pause on U.S. military aid to Ukraine. Now, the move stops weapons in transit to the country. It freezes billions of dollars of payments that were scheduled. Our Brussels bureau chief, Kevin Whitelaw, is with us. Kevin, we're also seeing some breaking news headlines coming from Ukraine. This is from, I understand, from the Prime Minister. Ready to sign a natural resource deal with the U.S., Ukraine to continue calm work with the U.S. to secure a peace. Again, trying to rebuild bridges. But the scale of the pause of military aid, what is it? What's the scale of sort of pullback by the U.S.? And what is this demonstration that the U.S. wants to see from Zelensky in the Ukraine?
Well, obviously, this all follows that disastrous meeting in the Oval Office where President Trump, and Ukrainian leader Zelensky, got into a pretty ugly discussion. The U.S. has, under Joe Biden, had rushed as much aid and as much military equipment to Ukraine as possible in the days, weeks, and months leading up to Trump's inauguration. But obviously, that it takes a while for all of that to flow through. So I think we're still trying to understand exactly how much this really applies. A lot of these figures are held pretty closely, and you're talking about sensitive military equipment. A lot of it's anti-aircraft and other kinds of defense weapons, but also, ammunition and more offensive missiles. And so the exact mix of what Ukraine has, it can survive a pause for a while, but obviously at some point that's going to become a very, very difficult sort of crunch moment for Ukraine as it tries to continue to hold off Russia, which has been slowly in some places winning back bits and pieces of territory.
Well, the language coming from the Europeans, Kevin, has stepped up to a completely different level when it comes to their own defense spending and their willingness to do European-wide loans, to do pan-European loans. We heard from the European Commission President Ursula von der Leyen about an hour ago, a little bit more than that, talking about that. What level of spending are we looking at coming from the Europeans?
Well, she's laying out sort of a series of options that she's hoping that leaders will be able to discuss when they have an emergency summit later this week on Thursday, and yet again in another one 2 weeks from now. And those options include a $150 billion loan program that the EU is going to propose that would be aimed at boosting defense spending. But they're also talking about freeing up sort of what they call fiscal space, basically easing the bloc's budget rules for defense spending to allow governments to boost spending and really invest in that. She says that if all the EU member states took full advantage of it, that could be as much as $650 billion over 4 years. So she came up with a number of $800 billion total. But obviously, on some level, those are still sort of, guesstimates and wishful thinking until countries decide to make the decision to invest in that money, to spend it. They still have to actually, pass it through their parliaments and everything else. So we'll see what this actually means, but the conversation has definitely shifted as the EU shows that it has to demonstrate to Donald Trump and to the administration that it's very serious about stepping up its commitment on defense spending.
Kevin, thank you so much for that update. That is Bloomberg's Kevin Whitelaw in Brussels, and you're watching Bloomberg Brief.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Let's get you ready for your trading day on this Tuesday. We're going to have some retail earnings. Target and Best Buy, they report before the bell. Nordstrom is after the bell. Then New York Fed President John Williams speaks at Bloomberg Invest at 2 p.m. Eastern, getting ahead of a blackout period. And President Trump addresses a joint session of Congress. That will happen at 9 p.m. Eastern. Manis.
Danny, got to see a green for you. You've got TSMC continuing to rally after they've announced their plans to invest an additional $100 billion here in the U.S. Okta, the shares jumped. The infrastructure software company reported earnings that beat. Nice strong forecast. And Walgreens up 5.6% on reports that Sycamore Partners are near a deal to buy the drugstore operator. And that takeover could lead to the breakup and the end of a pretty tumultuous run for a public company. Danny.
Take privates are in because deals have been stalling in this environment of tariffs and geopolitics. Just looking at some of the geopolitical fallout of more spending from Europe, Ursula von der Leyen announcing various packages that could total up to 800 billion euros, Manis. You got a German yield that's moving lower by 2 basis points in a euro that's at 105.
And just think of the divergence there in terms of the U.S. pulling back maybe a little bit on its fiscal stimulus relative to Europe. And as one analyst said, it could be a mega moment for Europe. That's it from Danny and I on Bloomberg Brief. Surveillance is right up ahead.
To succeed in Wall Street, what skills do you need? You need to be somebody who claws people in the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They were They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The idea that this tariff as a negotiating tool is too consensus.
We can talk about tariffs as much as we want, but we don't know what's going to happen.
The president seems to be far more serious about tariffs than was consensus in November when he won.
I really don't know. I don't think anybody knows but the president.
Policy backdrop is changing rapidly, and people are not sure exactly what to expect.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Is it Friday already? Hitting the ground running to start this trading week. Your scores look like this. Equity futures on the S&P 500 down by 0.1%. We are struggling to bounce following the biggest one-day loss of the year so far. Just one line from the president, shaking up global trade.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take effect tomorrow?
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. China also had an additional 10, so it's 10 plus 10.
As of this morning, 25% levies on imports from Mexico, from Canada, raising tariffs on imports from China to 20%. And this market reacting big time yesterday afternoon.
This market is falling out of love with the policy mix and the sequencing of Donald Trump. And I think that you can say that as you see the Magnificent Seven down more than 10% in the past 2 weeks, as you see the small caps really getting hit hard. A question here now is, are these on for a longer period of time, or how quickly do they come off? And that is the new hope for markets that maybe fully haven't grappled with the idea of not only tariffs, but retaliatory measures from Mexico, from Canada, and China.
To build on that, I think you're absolutely right. The people who believe this day wouldn't come now believe this day won't last very long. And these tariffs will be off in a week, 2 weeks, 3 weeks, maybe sooner.
We don't know. And another big question, of course, is if you have auto companies, which there's a lot of reporting in the Wall Street Journal that they were in having conversations and a dialogue with the administration. Will there be carve-outs in a few weeks or a few months? If you look at Trump 1.0, there were carve-outs. Remember before the election, though, Howard Lutnick, who ended up becoming the Commerce Secretary, said on this set and said there won't be any carve-outs. So now you have this whole game of chicken. When will these levies be lifted? And if not, what can we see? We know Canada's coming out with tariffs immediately. China's already done it. We're waiting on Mexico.
It's already in the data. You've seen it in consumer confidence. You're seeing it at the ISM yesterday on manufacturing. The headline number was okay, but beneath the surface, prices paid moving in the wrong direction. New orders, employment contracting. That's a bad mix for the economic data.
It is something that rhymes with ragflationary, or, this idea of stagflationary light. You have this idea that you've got a weaker than expected headline number, almost in contractionary territory, but the employment component very low, the new orders component. And you mentioned this, prices paid at the highest levels going back to June 2022, which was the peak of the inflationary boom that we saw after COVID.
If you are just joining us, welcome to the program. We're softer here on the S&P 500. We're negative by 0.1%, adding to the losses in yesterday's session. We begin with our top story, a green light for tariffs. President Donald Trump following through on threats to hit Canada, Mexico, and China. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington, Divya Balji in Toronto, Carolina Milan in Mexico City. Tyler, first of all to you. A lot of people thought maybe this day wouldn't come. Here we are.
Well, John, you heard President Trump there saying yesterday that there was no room left for negotiations. And we have to keep in mind that this specific batch of tariffs was really tied to some tangible policy priorities for this White House when it comes to immigration and fentanyl. We know President Trump was tracking closely overdose deaths as a metric leading up to today. I actually pulled the most recent data from the CDC, which shows that overdose deaths plunged last year by 24%, but it is still the leading cause of death among Americans ages 18 to 44. But as you've been discussing, this really kicks off a countdown clock that goes beyond this White House's border policies. Just look at President Trump's rhetoric around retaliation, for example. He's largely brushed off concerns, saying that that will ultimately just get factored in to those country-by-country tariff plans that we're expecting when his reciprocal plan is released on April 1st.
Caroline, I want to bring you into the conversation because we yet to know what Mexico's response is going to be. What are we waiting for?
That's right. There's a lot of expectation around President Claudia Sheinbaum's morning press conference that's held every day at 8:30 a.m. Eastern Time, and today is not an exception. Yesterday afternoon, when President Donald Trump announced that the tariffs were going forward, her team told us that there would be no statements until she speaks herself. So what are we waiting for in this press conference? Certainly to see if there's going to be retaliatory tariffs. Leading up to this day, President Sheinbaum has been talking about using a cool head, about waiting for the measures to be official, and she's also spoken about how the government has a plan A, a plan B, and a plan C. She hasn't yet disclosed what those are, so there's a lot of expectation around whether there will actually be retaliatory tariffs or some other kinds of measures. If there will be more measures alongside the border or related to security. And all of this comes at a point where Mexico's economy is poised to contract this year. So it's a very urgent moment for the country.
Meanwhile, Divya, we have gotten a plan A and a plan B from Canada. What are the details?
Yeah, so as of right now, about 25% of tariffs have been slapped on about 30 billion Canadian dollars, 30 billion worth of goods. Now, that's going to take in effect right now. It has been for the last few hours. And then from here, in about 3 weeks, Canada will slap another 25% tariffs on about $125 billion worth of goods. Now, this second amount, is really what's key here. It's hitting a lot of the big ticket industries, cars, trucks, steel, aluminum. That's really where you're going to see the big hit. I think, could this be seen as a bit of a measured response? Canada has been talking about doing it this way since the initial threat of tariffs. So is it possible that they're hoping to go back to the negotiation table and have a little bit more of a discussion before they actually have to put these new set of tariffs on in 3 weeks? There's also the possibility of, the whole fact that Trudeau is stepping down in a few days, the leadership race, does that call for something else? Is that why we have a few weeks for the larger amount of goods to get tariffed later? I think there's a lot of these questions that still have not been answered.
We're not done yet, that's for sure. Divya, Carolina, Tyler, thank you. On the agenda still, on the calendar, we've got 25% tariffs on steel and aluminum, potentially a week away. Early April, 25% on autos, chips, and pharma. This is just getting started. Julian Emmanuel of Evercore ISI joins us around a table. Julian, good morning to you.
Good morning.
I'm going to use your words to set up the first question. The sentiment shift during February to the type of pessimism more consistent with major bottoms after protracted sell-offs rather than so near all-time highs is nothing short of extraordinary. We're 5% away from all-time highs, and yet pessimism is falling off a cliff right now. There is literally no confidence at the moment from business leaders, from consumers, from the people we speak to day after day. What gives? Either sentiment needs to catch up or the market needs to catch down.
Well, two things just to highlight how extraordinary it really is. We looked at bearish sentiment, and at these levels, the average drawdown from the high is 29% when you get these levels. The lowest drawdown was 13%, and as you mentioned, less than 5%. It's really what it is again, as you pointed out earlier, there was not an expectation that we were going to get what we've gotten this morning, that the tariffs are actually on and in place. And to be fair, our house view is that they will not last that long because the damage to the economy is too great. But this is classic financial market risk reward. And when you talk to investors, they don't see the potential reward outweighing the risks of being aggressive here.
We started the show saying that people who thought that these tariffs were just a negotiating tool are now saying it's not going to last very long, and they're still just a negotiating tool. At what point does it become irreversible in terms of the effect on markets? The idea that even if they stay on for a prolonged period of time, that requires some sort of response in supply chains, in growth expectations, in, frankly, trade relationships globally?
Well, you're certainly starting to see it. And I think the uncertainty is also a function of the geopolitical chess pieces being reconfigured as well. And again, that ISM data, incredible. Prices paid, elevated, in terms of precautionary buying of goods. And then, of course, new orders falling off the cliff because you already bought the goods. There's a psychology aspect to this, which is what is very important. And I think it's also interesting because if you look back to the original trade war in 2018, when the stock market backed off, President Trump's rhetoric backed off, okay? The danger here is particularly when you look at 5,700, in our view, is important because that's where the market was on Election Day 2024. And he's never had what we'd call an adverse mark-to-market in either Trump 45 or obviously Trump 47. Does the rhetoric change? And the market is not so certain of that.
You mean the test of the Trump put, whether that actually still is in effect? If it isn't in effect, what's the downside? I mean, are you becoming actually bearish, or are you just saying that there's more heightened uncertainty on both sides?
So we have viewed 2025 as a continuation of the rally, but with the different character of what we call 3 steps forward, 2 steps back, heightened volatility. So whatever the baseline of volatility was in the VIX last year, 14, 15, that number is now more consistent with the long run average of 19. Could you get to a downside where growth sub 2% and inflation sticky towards 3% without a recession causes a test of a number like 5,200? It's certainly not outside of the realm of possibility. We'd treat that as a buying opportunity. But when you have this kind of uncertainty, you have to expand how you're thinking about the tails.
Julian, we're only 6 weeks into this administration, though. If he was to back off now, then he's the boy who cried wolf for every other date on that calendar.
Yeah, and that's part of the fact that, again, what did he learn from the first administration is that history tells you, regardless of circumstances, you're likely to lose the majority in the House in 2018, and we know the way politics works. They'll start running for the 2026 campaign this fall. You've got to front load everything, so the accumulated uncertainty is in these first few weeks, and it's sort of, let the chips fall where they're going to fall.
Would you buy stocks here?
We want to see a little bit more despair, quite honestly, consistent with that bearish reading. Yes, the market has acted as if it is approaching despair, but to us, when you think about all the catalysts, you think about that speech tonight where clearly he's going to talk tough, no question about it. You think about the potential for the government shutdown on March 14th, which matters now because of the perception of Doge. The risk is not quite balanced versus the reward at this point.
Fed on March 19th. How does all this change their meeting in a couple of weeks' time, 2 weeks tomorrow?
I don't know that the rhetoric is going to deviate that much. You might see downgrades to their economic forecast a little bit. If you're thinking about market confidence, you might want to see a slight downgrade to the inflation forecast, but you're not likely to see it because we really don't know what the effect of the tariffs are. The bond market's telling you that the inflation problem is not the problem, it's growth. But the statistics don't confirm that yet.
Final question, year-end price target, 6,800, correct?
It is.
For a lot of people, looking back to the election in early November, they made the argument that the overall policy mix was positive for stocks, pro-risk, pro-growth. The trade was going to be a tricky part of it, but it was one piece of a much bigger policy platform. Is that still the correct way to look at this country?
It is. But again, there has to be an understanding of how the pieces fit and a sensitivity around the fact that words clearly, even before the actions have been implemented, have consequences. And, from our point of view, our guiding light is that earnings growth still looks 9% to us. We have not moved. We don't anticipate that's going to come off.
Julian, appreciate your time. As always, sir. What a start to the week. Julian Emanuel there of Evercore ISI. We're late on the economic data today, but look out for tomorrow. ISM services. Will it confirm the slowdown in ISM manufacturing? And then it's on to the jobs data, payrolls on Friday. Equity futures right now on the S&P totally unchanged with an update on stories elsewhere. Let's get to your Bloomberg brief with Yahara Hecker. Say, Yahara.
Hi, John. President Donald Trump has imposed 25% tariffs on most Canadian and Mexican imports and has raised the charge on China to 20%. That affects roughly $1.5 trillion in annual imports. In response, Canada is set to impose phased levies on $107 billion worth of U.S. goods, and China is set to impose tariffs of up to 15% on American agricultural shipments. Meanwhile, the European Union will propose extending 150 billion euros in loans to boost defense spending. This coming as President Donald Trump pulls back on American security on the continent. The EU also plans to activate a mechanism that would allow countries to use their national budgets to spend an additional 650 billion euros on defense over 4 years without triggering budgetary penalties. And the FDIC is rolling back a Biden-era policy that required U.S. bank mergers to face steeper regulatory approval. The 2024 bank merger guidance was part of the Biden administration's effort to clamp down on consolidation among financial firms. The FDIC is also pulling back on a plan to enact tougher regulations of lenders' broker deposits. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara a little bit later on this morning. Up next on the program, the president follows through.
25% on Canada and 25% on Mexico, and that'll start. So they're going to have a tariffs. They can't come in and steal our money and steal our jobs and take our factories and take our businesses and expect not to be punished. And they're being punished by tariffs.
Up next on the program, Ed Mills of Raymond James as the President of the United States shakes up global trade and shakes up global markets. Equity futures negative 0.1% from New York City this morning. Good morning.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
So yesterday's session wasn't just about trade, it was also about the economic data. David Costin of Goldman Sachs writing this: an improvement in the US economic growth outlook will be required to fully reverse the recent equity market weakness. Not turning bullish on this decline just yet. Equity futures down by 0.1% on the S&P. In the bond market, yields just about unchanged. The 10-year 4.1644. Under surveillance this morning, the president follows through.
25% on Canada and 25% on Mexico, and that'll start. So they're going to have a tariff. So what they have to do is build their car plants, frankly, and other things in the United States, in which case they have no tariffs. I would just say this to people in Canada or Mexico: if they're going to build car plants, the people that are doing them are much better off building here, because we have the market. We're the market where they sell the most. It's going to be very costly for people to take advantage of this country. They can't come in and steal our money and steal our jobs and take our factories and take our businesses and expect not to be punished, and they're being punished by tariffs.
So here's the latest this morning. President Trump delivering on his promise to hit Canada and Mexico with a 25% tariff and doubling the 10% levy on China. Canada and China responding with tariffs of their own, while Mexico's president is set to speak later on today. Ed Mills of Raymond James joins us now for more. Ed, welcome to the program, sir. We said just moments ago that the people who didn't believe this day would come now believe this day won't last very long. Ed, what's your message for them?
My message is I feel like I've been the Paul Revere of tariffs all this year. Kind of the tariffs are coming, and no one has really believed me. I think that there is an element of this that is absolutely about negotiation, absolutely about using the economic strength of the United States to push our allies in many cases to make changes. And I think that's the base case. But I also have told folks here at Raymond James, expect a lot of these tariffs. If it's not at 25% permanently, does it come in at 5 or 10% permanently? Because bucket one is changing policy. Bucket two is having enough revenue to potentially pay for policies like the extension of the tax cuts in a couple of months here.
Ed, what kind of timeline are you giving for some of these exemptions or potentially the lowering of the tariff rate?
It's really hard to give a timeline because most, if not all, of this tariff authority is solely within Donald Trump's discretion. He can decide at 12 o'clock today to take it all off. He can decide at 12:01 to put it all in. When I've talked to clients at Raymond James, they're expecting there to be exemptions on medical equipment, things for humanitarian aids, things that are going to be specifically important to consumers like energy. We do have a lower energy rate here from Canada. Donald Trump very much cares about inflation, but he also wants to be able to show, as we have the joint session of Congress, I'm not calling it the State of the Union tonight, where he is going to push hard, and we're going to have reciprocal tariffs come April 1st, April 2nd, more tariffs. This is a steady drumbeat that's going to happen, and Donald Trump turning it on, turning it off is going to be part of the negotiation.
What's driving these tariffs is really the fentanyl deaths. Donald Trump has talked about that. The president, as well as officials, have spoken to me about that as well. Kellyanne Shaw, negotiator in Trump 1.0, said on Bloomberg Television earlier this morning, this is the new normal. They seem to be swapping what maybe you'd use sanctions for tariffs, and this is the new realpolitik. In that sense, then, how do you decipher what's negotiation for national security and what's going to be a revenue raiser?
That's up to Donald Trump as well. I mean, I think, Anne-Marie, you're absolutely right. Donald Trump has been very concerned about fentanyl, and I think with a conversation about China, a conversation about Mexico, absolutely part of the conversation, absolutely a huge issue that needs to be dealt with. When I talk to my Canadian clients, they're not really understanding why fentanyl is as big of an issue. There has been shipments across the Canadian border, but it doesn't actually happen all that often, especially compared to others. Donald Trump is going to use whatever excuse he has to push forward these tariffs, trying to get those changes. And it's not quite clear exactly what he asked for. When I talk to a lot of my contacts, foreign leaders are concerned about trying to strike a deal with Donald Trump only to be embarrassed. Look at the Oval Office meeting with Zelensky last week. If you are a foreign leader, you say, do I actually respond to these, and how aggressively do I respond to these? Or if I get to the White House, I think I have a deal, and it just devolves from there. That's a real concern globally.
Ed, has there been a shift in tone from your clients in terms of their belief in just this being sequencing, that the hard stuff comes first and the good stuff comes later?
So I'm right now at the Raymond James Institutional Investor Conference. We have over 1,000 companies and investors, and every single conversation I had last night was, is this going to be worse than we expected? We don't have a lot of conviction. There is a lot of angst out there. You go company by company. They haven't really disclosed exactly what the impact for them, oftentimes because they did not think this was going to happen. And so that uncertainty is a huge shift in tone. That kind of concern that this could last is a huge shift in tone. They're hopeful that this comes off, and I think the base case is that 25% on Canada and Mexico does not last for very long. But as soon as that gets pulled off, what happens with Europe? What happens with the rest of the world? Those concerns, which were kind of completely pushed aside, Lisa, are front and center in every conversation I'm having right now at our Raymond James conference.
Ed, how much at those dinners were people saying that they just are putting everything on hold? This is just a time to wait and see, and any plans for investment, any plans for deals are just going to have to wait until there is some more clarity.
Yeah, I think for investors, most need to be fully invested, so they are trying to figure out where they can hide. What are the opportunities for them to not get kind of hit by a buzzsaw on transactions and M&A, on IPOs? That is a lot more frozen or sluggish than expected, and that was a big theme as well in my conversations, like what was expected after November and into December and that euphoria. People are like, we need to understand where rates go, where tariffs go, what tax policy is. The long list of Trump concerns is the new conversation I'm having with clients of Raymond James.
It's a big change from where we were a few months ago. Ed, appreciate your time, sir. Thank you. Ed Mills there of Raymond James. We came into 2025 and confidence was sky high. And we said on this program that we wanted to see that translate into hiring, translate into investment. For a lot of people running companies right now, they believe the prudent decision is to do nothing. And doing nothing is showing up in the economic data. Inertia is there for all to see.
And that seems to be what we saw in some of the ISM manufacturing data, and the reason why the services data tomorrow is going to be so important. We've been talking about how there's this huge gap between consumer spend sentiment and corporate sentiment, and corporate sentiment has hung in there. Until now? I mean, that's sort of my question. Has that started to really genuinely shift?
Depends how long these stay on.
Yeah.
And we'll be playing that game day by day, week by week, month by month. Equity futures right now, the S&P 500 negative by not even 0.1%, following the biggest one-day loss of the year so far. Up next on the program, Sucharit Gadali of Forrester on the outlook for retailers. From New York, this is Bloomberg.
you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
So this time yesterday, we had an equity bounce, and that bounce collided with weak economic data and tariff headlines. Then we got the biggest one-day drop on the S&P 500 of the year so far. Equity futures this morning, no bounce. We're negative by 0.05% on the S&P. On the Nasdaq, almost totally unchanged. In the bond market, check out this run at the front end of the curve. 8 consecutive days of lower yields. That's the longest run since March 2020. When you see runs like that at the front end of the curve, it usually means great things aren't happening in the US economy, and this is off the back of weaker than expected economic data and the expectation there is more weak data to come. I want to finish on the commodity board. I want to talk about crude, both Brent and WTI, near the lows of the year. OPEC Plus talking about reviving output. We're lower again today. WTI with a 67 handle.
So they're putting more barrels on the market. We haven't seen this literally. There's been a hiatus of this for 2 years, and a lot of analyst notes are coming out. Halima Croft of RBC today, OPEC quick take, playing it safe. Playing it safe with who? The President of the United States in the Oval Office, Jonathan.
That's the latest on crude, 67, 69 on WTI. On our radar this morning, our top story, Canada and China slapping retaliatory tariffs on the United States. Canada hitting back with phased levies of $107 billion of U.S. goods. China imposing tariffs as high as 15% on agricultural shipments.
So everyone's going to say, all right, we have the retaliatory measures in effect, at least for 2 of the 3 that Trump put higher tariff thresholds on last night. What happens now at Mexico? We're going to be awaiting this very anticipated speech from the president. I'm interested in when it comes to China. Bloomberg Economics makes a very good point. When it comes to China, these targeted tariffs on things like soybeans, on cotton, on chicken, on beef, that might hit the President of the United States in the heartland where he has his base, and that could become a political problem for him.
I was struck by this study by the Budget Lab at Yale University that showed that the effect of the new tariffs on Mexico, Canada, and China is the equivalent to a 7 percentage point hike in the U.S. effective tariff rate, taking us back to the highest levels not seen since 1943.
Steve Cohen was super bearish compared to how constructive he has been over the last few years. He said this was the first time he was negative in quite a while. Said the tariffs are taxes, said that Doge was austerity, and that was basically the why.
And people are saying maybe longer term there will be a rejiggering of the world order and more domestic production. But how long will it take before that shows up in more positivity?
When it comes to that Budget Lab, they said that all these tariffs could mean $2,000 more in each U.S. household. Scott Bessent over the weekend, the Treasury Secretary, was talking about appointing an affordability czar. What do you think the first thing that affordability czar is going to give to the White House as one measure they can use to lower the inflationary and cost concerns for American consumers?
When the cost of living crisis really kicked in this country under President Biden, there were a lot of questions about whether the administration would remove tariffs, never mind put additional ones on. Ultimately, they decided to keep the tariffs on China, but that conversation certainly started over at the White House.
There is a sense that maybe there is a reprieve down the line. The question is, no one has a real sense of why these tariffs exactly are being used. Are they for national security? Are they as a cudgel for fentanyl? Or are they going to be to bring back domestic production? Until you know that, it's hard to know exactly what kind of negotiating tool they are.
That's the latest on trade. This is the latest on foreign policy. President Donald Trump pausing military aid to Ukraine. A Defense Department official telling us here at Bloomberg that Trump is waiting for Ukrainian leaders to show a good faith commitment to peace.
So this doesn't include the weapons that are in Ukraine, but any weapons that are in transit on aircraft and ships or waiting in transit as well in Poland, they are going to get this pause. Andrew Bishop sent out a note last night over at Signum. He said this was not the administration's maximalist option. The real tool to harm Ukraine would be cutting it off from intelligence rather than weapons. Clearly, though, Donald Trump, the President of the United States, is taking one more hit to Zelensky potentially to try to drive him to the negotiating table because they were not happy with what happened in the Oval Office.
This just catching my eye as well. I wanted to bring this story to you. Target numbers just crossing the Bloomberg, projecting little to no sales growth this year, coming in below estimates in terms of guidance on Wall Street. The company warning of meaningful pressure on profit, citing weak February sales and uncertainty around consumer sentiment and tariffs. Compare the outlook to the actual numbers in 4Q. 4Q numbers, EPS and sales coming in a little bit better than expected. So a beat to the upside for the actual numbers, Lisa, but in terms of the guidance, a downside surprise. As for the guidance, how much weight can you actually put on the guidance from a retailer at the moment?
Well, this is exactly what people are saying, that this is a whole bunch of lowering the bar to try to exceed that bar later on. That said, they talk about meaningful pressure on profit in the coming months. With weak February sales, they attribute it to cold weather. I never understood this. Cold weather prompts people to buy jackets and gloves. When it's too warm, they don't buy those. They always complain. But also uncertainty around consumer sentiment and tariffs. Consumer sentiment is going to be key in terms of the connection between what we're seeing in some of these surveys and how that plays out at retailers.
Target this morning in the pre-market positive by 0.6% to extend the conversation. To stick with retail, Sucharita Gadali of Forrester joins us now for more. Sucharita, welcome to the program. Target just about unchanged in the pre-market. Got a bit of tension between the numbers and the guidance. How much weight can we put on the guidance at the moment?
Well, I think the guidance is what has been driving a lot of these retail stock prices. We saw the exact same situation with Walmart the other day, where their overall numbers for Q4 were strong, but they too projected weak guidance. And if Walmart's numbers were going to be weak, it was going to be almost a foregone conclusion that Target was going to have a similar outlook. Target is a distant follower in the mass merchandise space. It did really, really well through the pandemic, but has essentially struggled since then. So it's not surprising to hear what we did today. But I do think that, to your points, exactly what was said about tariffs and consumer sentiment are the big issues that are likely going to be depressing most retail stocks for the weeks and months to come.
Do you think tariffs are a convenient scapegoat for a slowdown that had already started? Is there something else going on here?
Well, the tariffs absolutely are going to affect retailers to the negative, because a lot of these tariffs are affecting consumer goods. You have agricultural products in Mexico, you have from Canada, we have input costs, whether it is lumber or fuel, that are likely going to go up in price. And then you, of course, still have quite a bit of manufacturing, particularly in consumer electronics in China. And these are all consumer goods. So this is absolutely going to affect retail. Is it going to crush the retail industry? Most likely not, because it's going to be on a portion of goods, but it's going to be really difficult for the year 2025. And we really need to wait and see what is the purpose of these tariffs. And, is this political theater, or is this really intended to bring manufacturing back to the United States and reduce the current account deficit?
Sucharita, are we underestimating or overestimating how much these companies can pass along price increases to consumers?
Well, it's going to probably be, to some degree, inevitable that consumers are going to have to face some of the price increases, particularly when you're looking at agriculture and the grocery sector. The grocery sector just simply doesn't have the margin to be able to absorb all of it. So there's definitely some that will be passed on to consumers, but In some cases, you may see some of it being absorbed by companies over time. If you look at a consumer electronics manufacturer that's very profitable like Apple, they may be able to absorb more than, say, for instance, a grocer.
There's also a question about inventories, and we raised this before the earnings call, and I'm looking right now that I'm really not seeing a lot of insight into just how much they're adjusting their inventories to deal with what's coming down the pike. What are you hearing, though, about other retailers and how they're adjusting to try to be a bit proactive?
Well, it seems that what we learn from history is that we don't always learn from history. And what we saw during those supply chain crunches in the last few years was that we should be having more resilience in our supply chain. But it's not clear that companies have necessarily managed to have more flexibility, whether they've diversified their supplier base as much as they could or should. We have seen some offshoring and some nearshoring to reduce some of the dependency on China. But for the most part, we still have single nodes of supply, and in order to keep prices down, and that's something that if that single node happens to be in China, Mexico, or Canada now, that's problematic.
So, Trina, what did these corporations and retailers learn from Trump 1.0 when it comes to trade war?
Well, I think that there was wishful thinking that there was more talk than action. So I think that that's really what perhaps some of the optimism, or the continued optimism that came through his election was really about. Was the hope that it wouldn't affect their industry, or that it was just simply a negotiating tactic. And what we see now, it's still very early days, and what we know is that there's still a lot of uncertainty, and things change very quickly in a Trump administration. I mean, we may have tariffs this week, and it's very likely that in the next few weeks things could be completely different. And I think that's what's adding to the volatility and the uncertainty in the market, is that all we know is what has been announced, and the downstream effect on businesses and the downstream impact on their pricing is still to be seen.
Based on these headlines and this guidance, is this company effectively conceding? Is Target conceding they can't pass on higher costs to the consumer anymore? Is this a change compared to where we were a few years back?
Well, it is certain that's actually been the case for some time, where the consumer sentiment is largely tied to inflation levels and is largely tied to those higher prices. So I think retailers for some time now have realized that they have limited ability to pass price increases, particularly for consumables and commodities, onto shoppers. So the bigger question, though, is whether or not Target believes that the U.S. economy is going to be resilient over 2025. What we saw over the last few years is retail spending has still been very, very strong, even in spite of low consumer sentiment. And what is different now is retail spending may actually be down in lockstep with consumer sentiment, and that's not a good thing.
Target, just about positive in the pre-market today. Sucharita Kodali there of Forrester on the latest. Target coming out with numbers, looking for flat sales this year, warning about pressure on profitability and citing risks from trade tariffs. Trade tariffs in front and center for the story so far this morning. Within that, there is somewhat of a concession that we're not in a position to pass on higher costs to the consumer like we were a number of years ago.
And that seemed to be something that we're hearing across the board, that essentially you're not going to get the same type of price hikes. That said, there are questions about just how much they can pass along, and where I do want to put into perspective that Target shares are down about 10% so far this year. So if it is bouncing a little bit today, maybe it's on a bit of a relief rally that they posted better than expected fourth quarter earnings.
Down yesterday as well, off the back of those trade headlines. Equity futures right now on the S&P 500, down as well by about 0.1% on the S&P. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. Recapping those earnings, Target delivered a disappointing sales outlook for 2025. The retailer expects comparable sales to be flat this year, falling short of what analysts were expecting. Meanwhile, net sales are expected to climb around 1%. The company also warning of meaningful pressure on profit in the coming months, citing uncertainty around consumer sentiment and tariffs. But as you said, shares are higher in the pre-market. Meanwhile, China's biggest political event of the year is underway. President Xi will unveil the latest stimulus plan for the country at the National People's Congress. Thousands of delegates and leaders are expected to push China's official budget deficit target to its highest level in over 3 decades. This comes, of course, after President Trump slaps an additional 10% tariff on the country. And we end with the latest on the Pope. This morning, the Vatican is reporting that Pope Francis slept well through the night after they said yesterday that the Pope had experienced 2 episodes of acute respiratory failure. His Holiness has been receiving treatment for bilateral pneumonia at Rome's Gemelli Hospital since February 14th. That's your brief. John?
Yahara, thank you. Appreciate the update. More from Yahara in about 30 minutes' time. Up next on the program, U.S. commodity dominance.
We've got this window, this wonderful gift, quite frankly, that the shale industry gave the United States, which is we went from being the largest importer of energy in the world to the largest exporter.
A conversation up next with Dan Stuyven of Goldman Sachs from New York City this morning. Good morning.
About artificial intelligence. Is artificial intelligence going to enable you and others to say we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
waking up to 25% tariffs on Mexico, on Canada, an additional 10% on China. Equities yesterday, the biggest one-day loss of the year so far. No bounce this morning, so far at least. Equity futures just about unchanged. In the bond market, yields higher by a single basis point. 10s at 416. In commodities, crude, new lows for 2025. We're down by 1.26%, 67.50. Under surveillance this morning, U.S. commodity dominance.
We've got this window, this wonderful gift, quite frankly, that the shale industry gave the United States, which is we went from being the largest importer of energy in the world to the largest exporter and in energy self-sufficiency for a period of time. And so that's a window, though, that won't last forever.
So here's the latest this morning. Oil falling as OPEC Plus moves to revive halted production amid pressure from President Donald Trump to lower prices. Dan Stuyven of Goldman Sachs writing commodities are front and center in President Trump's trade and foreign policies as his administration pursues U.S. commodity dominance, spurred by competition with China. Dan joins us now for more. Dan, good morning to you.
Good morning.
What happened in Riyadh a few weeks ago between three of the biggest exporters and producers of U.S. crude on the planet?
So yesterday, OPEC decided to raise production in line with their announced schedule, but against consensus expectations. In our view, this primarily reflects two factors. Number one, inventories have fallen. You're actually at the lowest level of global commercial inventory since mid-22. Second, I think since last summer, when OPEC announced its data-dependent plan, I think the group is shifting the market modestly to an equilibrium where OPEC is really controlling spot balances, reducing volatility, to now a situation where they're also discouraging supply growth and supporting internal cohesion, making sure that compliance with those cuts is strong enough. We think those are the two key drivers here.
You managed to offer an explanation without mentioning the President of the United States. I tried to take you there. I'll try again. Has President Trump got a role to play here?
So as I said, I think there are more important drivers that I just sketched, and I would bring in two additional points of context. Historically, there have been instances where clearly publicly the U.S. president has discussed oil policies with Saudi Arabia and Russia, for instance in 2020 and also in 1986. But actually in both instances, the problem was that prices were too low for the U.S. producers. We think that the current price levels, and we still look for Brent in sort of the high 70s, TI in the low 70s this year, we think current price levels work reasonably well, both for the U.S. consumer, U.S. producers, and for Saudi Arabia and Russia.
Right now, though, he wants to get energy prices lower, bring down the cost of oil. He told OPEC Plus last month. How does he work on bringing down the cost of oil, but at the same time meeting Scott Bessent's long-term plan for 3 million barrels more coming out of the United States? What's the price point that is basically worthy of American consumers, but also corporations to want to keep drilling?
Yeah, so exactly. We think that current price levels are still essentially the sweet spot where you have both affordability, because U.S. consumers start to really focus on U.S. Gasoline prices. You see really a spike in U.S. gasoline media mentions once you're above $3.50 per gallon for U.S. retail gasoline prices, which is mid-80s for Brent. We're still below that. And on the producer side, we find that U.S. crude supply growth slows down more meaningfully when prices drop into the 60s in Brent terms. And we're still slightly above that level. So we think we're still in a sweet spot. At the same time, I think you're right that some key members of the administration, like the president, seem to be publicly a bit more focused on the consumer side, on the affordability side. At the same time, I think that other members of the administration also emphasize the key need for stronger U.S. exports, which is a source of economic and geopolitical power, which in our view requires prices not to grow much further from here.
What's going to be the impact of this 10% tariff on Canadian crude?
So if it becomes confirmed, we think that the burden of a 10% tariff on Canadian crude would be borne both by Canadian producers, because you would see a sharp discount in Canadian crude prices on the one hand, and on the other hand, the U.S. consumer, where we would expect a pickup in U.S. refined product prices. I think the key reason a large share of the burden, about 3/4, would fall on Canadian producers is that there are not a lot of alternative outlets for these Canadian barrels. There are constraints in terms of pipelines and other export transportation mechanisms, and so those Canadian producers would likely be forced to discount their barrels to make sure they can continue to go to Midwestern refiners.
We're hearing some tough rhetoric coming from Canada. The Ontario Premier is talking about willing to do anything, even cutting off energy. What would that do to these refiners in the Midwest?
So we think that U.S. Midwestern refiners are really set up to use those heavy Canadian barrels. At the same time, I think they have some bargaining position vis-a-vis the Canadian producers who also have limited alternative options.
In the past, there have been allies and there have been rivals when it came to the oil patch. Are those alliances shifting in a way that could potentially shift the levers that you have to watch as you determine what the calculus is behind whether production increases or decreases?
So we think that the key data points to watch from the U.S. perspective are the U.S. cost curve, where production growth should be solid when you're around current price levels, but where you can't really afford to fall a lot lower in terms of prices. And then, of course, U.S. retail gasoline prices, which could be affected by global crude prices, but also by tariffs.
Well, what I was trying to get at is, in the past, it was the U.S. over here versus OPEC, and Russia and Iran and Saudi Arabia kind of negotiating and haggling within themselves and seeing the United States as the big bad wolf over here producing without any constraint. Has that dynamic shifted fundamentally in a different way?
We think there have been instances in the past where Russia, Saudi Arabia, and the U.S. discussed global oil markets and discussed what are possible price levels and possible policy levers. In 2020, President Trump publicly tweeted that he convinced OPEC Plus to cut production to prevent prices from really leading to significant U.S. drops. In the mid-'80s, when Saudi Arabia was incentivizing its partners to improve compliance by raising production, the U.S. administration was also discussing oil market policies. And so if we were to see discussions between Saudi Arabia, Russia, and the U.S. on oil markets, it wouldn't necessarily be such a break from historical patterns.
Let's finish on metals. A week tomorrow, I believe, 25% tariffs on steel and aluminum. What's the base case for you and the team?
Yeah, so we incorporate that you have 25% tariffs on steel, aluminum, likely also later copper. What are the implications? We think higher U.S. prices for metals with pretty much 100% pass-through to the U.S. prices of steel, aluminum, and copper if we get it. The production effects would be more mixed, with some meaningful upside over time to U.S. Copper production, but pretty limited effects, for instance, for aluminum, where access to power, cheap power contracts is a challenge to restarting production significantly at higher levels.
Dan, appreciate your time. I'm sure you're busy. Everyone is at the moment. Dan Stuyven there of Goldman Sachs. The tariffs go on this morning, 25% tariffs on Mexico, on Canada, an additional 10% on China. And next week, tomorrow, we're going to get potentially, according to the team at Goldman, 25% on steel and aluminum as well.
Which is the reason why people are looking at autos in particular to see whether this is going to hit them in a double whammy on all sides, whether it's the input production costs or just simply where components are coming from, i.e. Mexico, i.e. maybe somewhere else too.
GM down yesterday, but not doing much in the pre-market. The autos so far in early trading at least, doing okay. We'll see how that picture changes through the hours still to come. Up next on the program, the second hour of Bloomberg Surveillance. We'll catch up with Stuart Kaiser of Citi, Don Schneider of Piper Sandler, Kit Jukes of SocGen, and the former NEC Deputy Director Everett Eisenstadt. That and more still to come.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent
Which
the
is a
Bitcoin
lot, by
on
the way.
beer and groceries and gas and video games.
And
I wish I had
hogs.
kept it. I wish I would buy a Harley today if I had.
Yeah, but you
that
probably wouldn't be
Bitcoin.
a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch with lots of supporters, a really mind-blowing level of innovation against emissions. And, in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Tariffs are looming over the market.
We see quite a big hit from the tariffs of about 1 percentage points on growth. That would be a disaster.
The likelihood of tit-for-tat retaliation is definitely something that we need to worry about.
I think there's going to be some issues for the consumer.
I think that's the thing we're going to live with for the next few months, if not next few years, which is multifaceted trade policy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, so let's start with the scores. Equity futures on the S&P 500 down by a little more than 0.1% yesterday, down by almost 2 percentage points, the biggest one-day loss of 2025 so far. In the equity market, looking at the Nasdaq, down by a whole lot more than the S&P yesterday. This morning, just about unchanged. This morning, waking up to a new dawn for global trade. 25% tariffs on Mexico, on Canada, an additional 10% on China.
People who thought this wasn't going to happen have received maybe a cold dose of reality at the same time. It seems like that reality is now just wait and they'll be taken off soon enough. A question here really is how much are we seeing a downward move in markets because of the growth data that we keep getting or because of the policy mix? Parsing out those two getting increasingly difficult.
The path forward is unknown. What we do know is that there's now tit for tat. Canada has announced tit for tat measures, retaliatory measures to these tariffs. China has as well. We're just waiting on Mexico to see exactly what the president there wants to do. They have an A, B, and C plan. Canada's immigration minister said this: it's a moving target, and that's frustrating. The same people who didn't know whether or not these tariffs would come on also don't know potentially when there could be a relief valve.
There is a distinction, though, to draw between what everyone's saying about markets and what markets are actually doing. And I'm talking about stocks. Stocks are still only 5% away from all-time highs. It's a 5% pullback. Just think about that. In the context of all the doom and gloom of the last few weeks, we're only down by 5%. So either you think that sentiment has got to catch up or this market's got to catch down, but something's got to give here.
Well, something's got to give between the fact that when we talk about sentiment, who are we talking about? Are we talking about one another? Are we talking about consumers? Are we talking about corporate executives? Because frankly, you heard David Solomon of Goldman Sachs yesterday come out and say he still sees the chance of a U.S. recession as fairly slim. You know, Steve Schwartzman, similar kind of tone tone, yes, these are people who have to run big businesses and are still investing. So at what point does the negativity that we're seeing among consumers bleed into the corporations that have to make these big decisions?
It's not their baseline, but the chances of it happening aren't zero, and the chances went up off the back of the economic data we've seen so far. Just remember, we came into 2025 with confidence sky high for consumers, for businesses alike, and we were hoping they were going to do all these great things, invest and hire, and now we're starting to sense some inertia. I think we could sit here all day and talk about whether the tariffs stay on, the kind of impact it will have. It's already in the data. We're already seeing it in confidence. You're already seeing it in the ISM manufacturing.
ISM, if you look at those write-ins, overwhelmingly, it was about tariffs and those concerns. There's also something else. Is Trump 1.0 the same as Trump 2.0? In the sense that Donald Trump used to always quote and look at the stock market, the Dow Jones, and that used to be for him a reflection of his policies and his administration. Are they doing well? Mike Wilson sat around this table and said, have you seen many truths about the stock market lately? You haven't. Does he care as much? Is that going to be a check on some of his policies?
Just where is that Trump put? Equity futures right now in the S&P negative by 0.2%. Coming up this hour, Stuart Kaiser of Citi on a brewing global trade war. We'll speak to Don Schneider of Piper Sandler as President Trump delivers on tariff threats and the former NEC Deputy Director Everett Eisenstadt warning of choppy waters still to come. We begin this hour with stocks looking to recover after the worst sell-off of the year so far as trade tensions continue to escalate. Stuart Kaiser of Citi is watching consumer sentiment, writing tariff headlines alone are not insurmountable. The pass-through to consumer confidence is the issue. That process has been stronger, faster, and more dramatic than anticipated. Stuart joins us now for more. Stu, good morning.
Good morning. How are you?
I'm all right. Do these tariffs make it a whole lot worse?
You know, the tariffs matter, but again, I think, as you all mentioned, it's the pass-through to economic data, and I think actually more important for equity markets, we've seen a pullback in retail investor sentiment. We've seen a pullback in the inflows into U.S. equity markets. So you kind of entered this year with a really strong foundation in markets from earnings growth and GDP growth and a supportive Fed. You had really big risk reward from policy and things like that. When you start to see the economic data, kind of wobble a little bit, now you're talking about how firm is that foundation. So I think it's kind of a different game we're playing now, and I think it's a lot more risky than what we had, a month or.
When do interest rates start to provide some support? You've been pretty consistent on this. You wrote in your recent piece, we continue to see a 3-handle on 10s as worse for equity markets than a 5-handle, given the data required to push yields down to those levels. When does that mood start to change on that front?
I think it's going to take a bit. I think you're probably going to need the Fed signaling that they feel like they need to come in and cut rates to support the market, and I don't think we're anywhere, near being there yet. So I think just the 10-year yield moving lower, particularly to your point, if it's coming from weaker growth data, is not really a support for the market. I think you would actually need the Fed to come in and sort of acknowledge that they're a little bit concerned with the economic data, and that they maybe, want to provide some policy support. The fact is, though, equity markets are going to be a lot lower if that eventuality happens. So I think that's kind of a be patient and wait for that to happen. You don't want to kind of pre-trade that.
John was talking about how the market's only down about 5%, even though sentiment evidently is rock bottom among a lot of people. How do you explain that differential?
Look, I think consumer sentiment is a survey, same as ISM is a survey. We're going to have to start to see it, I think, in the hard economic data. If you look at Atlanta Fed GDP, that has come off. The PCE data last week was weak. So I think the dislocation here is, consumer sentiment. I think we need to see that flow through, probably to the labor market. Our general view has been the unemployment rate is the single most important data point that matters. That means Friday is super, super important. So, yeah, I think that it's early stages. As we talked about earlier, in August of last year, you did have a kind of wobble in the data already. The market's been fighting off kind of recession talk now for 2 or 3 years, so I think there's a little bit of a once bitten, twice shy on that as well. So I just think I think we're a little bit early stages. We're going to need to see that consumer data kind of flow into actual real labor markets.
In previous downturns that were often credit-driven, high-yield bonds were a tell, credit spreads were a tell. I'm wondering how much the script has shifted, because this isn't going to be any kind of credit-driven sell-off. It certainly isn't right now. How much are the financial stocks that tell in terms of that bet on mergers and acquisitions and deals activity continuing to flow through?
It's a great question. I think the reason the credit market isn't the tell right now is because corporate balance sheets are healthy, right? This is an issue of U.S. government debt. So I think if you were to see the bond market impact equities, I think it's going to come from either the 10-year down on growth risk or the 30-year up on inflation and deficit spend. So I think that's the difference between, let's say, today and back in 2009. It's who owns the debt. And right now it's kind of held by the government. Financials is a good question. I mean, we like M&A targets as a theme. Those stocks have performed absolutely horribly, to your point, because that's a risk-on sentiment, kind of trade. So financials have been totally Teflon, frankly, for the last 3 months. The market sells off. There's a bid below on those stocks consistently. Financials were up over 2% last week. So I think if you were to see financials sell off here, that tells you, I think, that institutional investor sentiment has declined, and that would be, I think that'd be definitely a red flag for the market.
How much is the market earning for the other part of Trump's policies, the quote-unquote good stuff, the tax cuts, which potentially might not get to the very end of the year?
I think it's a great question because back in 2017, the order was flipped, right? We did the good news on the taxes first. We did the bad news on the tariff second. Now we've kind of flip-flopped that. In my view, honestly, the next month is going to be very interesting. If you look at the House's resolution 2 weeks ago, $1.5 trillion of spending cuts, $4.5 trillion of tax cuts. That is a $3 trillion gap that kind of needs to be dealt with, right? So I do think the budget and deficit headlines, particularly over the next kind of 4 to 6 or 8 weeks, are going to start to really matter because Trump does not want to leave this until December, right? He wants these deals done now. And as you know, I think once a congressional budget office or somebody scores some of these things, it's going to look kind of ugly, from a deficit perspective.
And in between all that, potentially we're looking at a government shutdown next week. You mentioned the fact that the Fed is going to be focused on unemployment. We have a jobs number this Friday. We're looking at 160,000. What kind of number do you think there needs to be for the Fed to maybe bring up the thinking that they're going to have to cut sooner?
I think we're a long way away from that, to be completely honest with you, just because with the unemployment rate at 4 and having declined the last couple of months, they're probably feeling pretty good about things, from a labor market perspective. The type of data on Friday that will get you concerned would probably be you print, kind of low 100K type numbers, 125K, let's say, and you actually see the unemployment rate rise. Because consensus, is, to your point, is at 160 with the unemployment rate staying at 4. I think if you saw like a 4.1 or a 4.2 on the unemployment rate, people step back and say, oh, now this consumer confidence stuff is actually appearing in the labor market data. So I think risk reward around Friday is pretty poor. If you print a strong number, it's going to be, yeah, but. If you print a weak number, it's going to be, oh my goodness, they've actually managed to really, hurt the labor market in a rapid fashion.
The Fed knows how to respond to, oh my goodness, though. They know what to do. You cut interest rates. What they won't know what to do, what will be a bigger struggle is stagflation. The Target CEO was speaking to the American media just moments ago and said that price hikes in coming days could be coming due to tariffs. Lisa, the pass-through to the consumer is the biggest question we've got to ask here this morning. 25% on Canada and Mexico, additional 10% on China. Are we in a different place? Are they able to pass on those costs to the end consumer? If they try to, do they get pushback? What does that mean for top line and bottom line growth going forward from here for a whole bunch of companies?
Is it going to be this idea that people are dealing with higher prices at the stores? Is it going to be that stock investors are dealing with just profit margins that are compressed across the board? Or is it, yes, that essentially there's going to be a little bit of both, which seems to be the consensus?
Stu, when you sit down with the economics team at Citi, Andrew Holdenhorst and everybody else, what do they say about that?
Look, I think the risk on the econ side, which what you described for the Fed in particular, is you've got DOGE / expense cuts that are negative for growth, and you've got tariffs that are stimulative on the inflation side. So it kind of attacks them from both sides of the dual mandate. So I think economists are looking at this, and that's what you're trying to figure out. I you have to have one egg for breakfast instead of 2, John, and it's...
Am I cutting back?
I don't know how many eggs you eat, but...
Never just one.
No?
That never makes sense, just one egg. I mean, who has just one egg?
This has to be bad for the GLP-1 theme, right? People eating less eggs. So
one egg is kind of sad.
It is a sad breakfast.
I'll cut back elsewhere. Stuart Kaiser of Citi there. Who has just one egg?
Well, only if it's an adornment for a dish. Then you can have one egg.
Okay, sure.
But other than that,
like a poached egg on something.
Correct. Like on avocado toast, that makes sense. But one egg by itself.
It's got to be like minimum 3.
Yeah, I would agree with that.
Like,
well, yeah, minimum 3.
Minimum
that means
3.
Minimum 2 because it's 2 pieces of toast. I think that's fair. Minimum 3 if you're,
It's a first world problems, aren't they? How many eggs are you eating? Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hacker. Say, Yahara.
Hi, John. We start with Best Buy. Those shares are rising 2.7% in the pre-market after its fourth quarter comparable sales beat estimates. The retailer also bumping its quarterly cash dividend a cent to 95 cents per share. Best Buy expects consumers will remain resilient, but will be more value-focused as high inflation continues to weigh on them. Meanwhile, Aramco shares are lower after the Saudi oil giant slashed its dividend in a bid to ease stress on its finances. Payouts will amount to $85 billion this year, down from $124 billion in 2024. Aramco also reported weaker earnings due to weak oil prices and production near the lowest level in more than 3 years. And nearly 100,000 California workers are ordered to return to work by Governor Newsom. Starting in July, state workers will have to return to their offices 4 days a week. California's 224,000 workers are currently required to go into the office at least 2 days a week, with many already required to be full-time in office. That's your Bloomberg Brief. John?
Yahara, thank you. Every picture I see of Governor Newsom, the governor of California, always looks so happy with himself. You know, it's like every single picture.
He's got very good hair.
He's got that
He's got a
Hollywood
new
thing
podcast
going.
out now,
Hasn't he? He just looks so happy every time I see him. Getting some headlines here I want to share with you just briefly. Things have changed at the Federal Reserve so quickly. Only a few weeks ago, on this program, we had guests talking up the potential of rate hikes and not rate cuts. And now all of a sudden pricing in fully 3 cuts for 2025. The next meeting 2 weeks tomorrow, March 19th. That meeting for this Federal Reserve is changing very quickly. 2-year yields down for 8 consecutive sessions. We're down 4 to 390. Up next on the program, following through on tariffs.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take?
No room left for Mexico or for Canada.
Waking up to 25% tariffs on both of those nations. In just a moment, Don Schneider of Piper Sandler joins us next. From New York City this morning, good morning.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Down hard in yesterday's session, just beginning to drop a little bit this morning. We're down by 1/3 of 1% on the S&P 500. In the bond market, yields lower again. We're down by a single basis point on 10s, 4.14.17. Under surveillance this morning, following through on tariffs.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take effect?
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. China also had an additional 10, so it's 10 plus 10.
So here's the latest. President Trump hitting Canada and Mexico with 25% tariffs and doubling the rate on China to 20. Canada and China responding with retaliatory levies, and Mexico's president set to speak later on this morning. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, let's talk about it. This is what's on the table now. Over the next few weeks, there could be more still to come. What's on the table over the next month?
Right. Well, John, Ed Mills of Raymond James told you on this program last hour that we are expecting this steady drumbeat and that moving the tariffs up and down is all just part of that negotiating process. When we look at the calendar, March 12th, that's when we are expecting additional tariffs on aluminum and steel that could particularly impact Canada and Mexico. April 1st is when we are expecting Commerce and USTR to unveil their reciprocal tariff plans when it comes to their country-by-country calculations. Those could then go into effect on April 2nd, along with a whole host of tariffs on additional goods, including pharmaceuticals, autos, and chips. Of course, though, this is going to start to be a tricky needle to thread for this White House when it comes to messaging to the American consumer. I actually spoke to one Republican congressional aide earlier this morning who told me that yesterday they saw calls starting to surge to their local offices, not necessarily their Capitol Hill offices, which I thought was interesting. Their local offices embedded in these communities where constituents are asking how tariffs are going to impact inflation, particularly after that preliminary report had come out that Beijing indeed was looking at targeting those U.S. agricultural products. This Trump White House has really campaigned on bringing down costs for American consumers. And if you ask any senior administration official, they're going to tell you that it's against this backdrop of a broader macroeconomic plan that will help to offset these concerns. A big part of that, of course, John, is President Trump's tax cut agenda. He views these tariffs as a revenue raiser, but important to keep in mind that fiscal hawks on Capitol Hill are already starting to raise concerns about making his 2017 tax cut plan permanent.
Tyler, when it comes to messaging, how difficult is it going to be also for Trump's cabinet? Howard Lutnick, the Commerce Secretary, was saying this was a fluid situation, and he sort of signaled that there would be tariffs, but they may not be as high as 25%. And then Donald Trump said, nope, no more room to negotiate.
Right. It's showing us that this is really a process that is evolving as it speaks, right? We were looking to see if perhaps our reporting that had indicated that we had asked Mexico and Canada to up their own tariffs against China. It's going to be a fluid conversation going forward here. But as we are seeing, and you've been discussing all hour on this program, the consumer sentiment data, Target also in terms of its sales growth forecast, it's all going to end up coming back to the American public and how they are going to view this White House's policies going forward.
Tyler, thank you. I keep seeing phrases like wake-up call, Lisa, reality check. And then I just think of where consensus is right now. Consensus has gone from this wouldn't happen, new consensus has happened, is it won't last very long. I'm not sure that's a wake-up call or a reality check just yet.
This is sort of the wake-up call where the lights slowly get brighter, not necessarily the wake-up call that's, that kind of thing.
Is that your wake-up call in the morning?
Actually, no, I've got to say.
Super weird.
All right, let's move on.
Single egg breakfast and stranger lines.
How did you put that on me?
Dom Schneider of Piper Sandler writing this morning. This only gets harder if Canada and Mexico retaliate. The proximate issue could be fentanyl shipments. But is this really a plausible justification for tariffs on Canada? Why isn't there a clear criteria for what objectives must be met? Don joins us now for more. Don, welcome to the program. Can you answer your own question? Let's start there.
Yeah, I don't think there is a clear criteria. I think the fact of the matter here is that Trump believes tariffs are good, and he sees them as a win-win. Either you get the concessions on trade and fentanyl or other things, or the inverse, which is that you get the production that's built here, and it's an economic win. So, I think there's, in the case of Trump, he has this unique ability to declare victory at any time. I think the criteria here is relatively simple. He could declare victory on, ending fentanyl shipments, of which there were 40 pounds coming from Canada that we've caught total, relative to the 21,000 pounds we've caught vis-a-vis Mexico. So he does have the ability to declare victory at any time. But I think that the simplest solution is that he just simply likes the tariffs and thinks they will be beneficial for the U.S.
Canada's Immigration Minister Mark Miller talked about how the fact that in these negotiations with U.S. officials, it's a moving target, and that's frustrating. Do you know where the target is right now? What more concessions, specifically when it comes to Canada, this administration wants to see?
I don't think there really is anything on the immigration front. I really think it's fentanyl when it comes to the northern border. On the southern border, the illegal border crossings are well below even 2019 levels at this point. So, I think on both of those, measures, there has been success, and what more needs to be seen. I know Trump has made comments in the past, for example, saying he wants auto production back to the U.S. So, I think that's more, we're going towards that direction, that this is what this is about. This is about bringing production back to the U.S. And if I think the market reaction becomes, too painful, which at this point it isn't, then he has the ability to declare victory and roll the tariffs back and then focus on a more product by product or basis, with whether it's steel and aluminum or lumber or things like that.
We've seen the retaliation from Canada and from China. What are you expecting from Mexico?
Their response has been muted so far. They've been constructive as well. I think they raised the possibility of tariffing Chinese goods. I think getting creative and, is this enough? But I don't think the nature of the retaliation would be that much different from Canada or Mexico. The goal, from Canada or China, the goal would be, target products and say that are quintessentially American, products that are relatively more painful or sensitive, or goods that are in, Republican districts, so that lawmakers feel pressure and apply that pressure then to Trump.
Don, when you talk to clients, do they believe that these tariffs are going to stick?
No, not up until now, and I think it's still sort of a jump ball as to whether people believe they will stay in place. After, Trump announced these tariffs coming into effect February 4, said there's nothing you can do to change my mind, and then did not implement them, I think people started to take him much less seriously, either, thinking he had won, he got the concessions and say, this is what tariffs are all about. You get concessions, and then the other side saying, no, he was worried about the market consequences. Either way, people did not believe these were going to come into effect. And I think in part because there really isn't a good rationale for putting tariffs on our closest trading partners. I think the reciprocal tariffs made a lot more sense, which is let's threaten tariffs on countries who levy higher tariffs on our products in hopes that both sides can lower tariffs. That is a rationale that I think makes sense. In this case, it doesn't. So I think the market participants are waking up to the fact that Trump likes tariffs and they're much more likely to stick. But even if they do roll off in this case for fentanyl and immigration concerns, I think there's all sorts of products that Trump does want a tariff, and he does want to renegotiate USMCA. So either way, I think we will end up with higher tariffs on Canada and Mexico.
Don, you used to be the chief economist of the Ways and Means Committee. You've seen the sausage and how it works. You've analyzed these budgets. Is there any way that these tariffs could actually be much less punitive than some people are arguing and modeling out in terms of both decreasing growth and, on the margins, at least initially, increasing inflation?
There's been some great work by the Yale Budget Lab quantifying the effects of these. So these 20% on China, 25% Canada, Mexico would be a tax increase of about $1.3 trillion over a decade. That's about 40 basis points on GDP, and would subtract, year over year, about 60 basis points from real GDP growth. So I would say the negative growth consequences in the short run from such a policy outweigh the positive growth impacts of extending the 2017 tax cuts and even some of the kind of smaller pro-growth policies they're considering implementing in that context. So it's already kind of brings us to modestly growth negative or a wash. And, as for the deficit impact, we had a 6.5% of GDP deficit last year. These are about a 40 percentage point reduction in deficits. But of course, we're about to extend, $4 trillion in cuts and add a bit more on top. So I think it kind of leaves us with a modestly negative growth picture and then sustained high deficits.
Hey, Don, thank you. Got to leave it there. Don Schneider there of Piper Sandler. Got to get you up to speed on a price action. This market stateside slowly waking up at the front end of the curve. Yields lower for 8 consecutive sessions. We're down below 390, 389 on twos. And traders building bets for more cuts still to come in 25. They're looking for three fully priced. Kit Jukes of SocGen up next.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more. It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
This market rolling over in the last 10 minutes or so, down across the board here. On the S&P 500, negative by 0.6. We're down 0.75% on the Nasdaq 100, following the biggest one-day loss of the year so far. Over in Europe, I'm looking at Germany, the DAX, still up double digits for the year, but down this morning, going into this afternoon over in Europe by more than 2%. The biggest one-day loss since 2023, potentially. The idea being, yes, 25% tariffs on Mexico and Canada, Europe. You're next. In the bond market, 2-year, 10-year, 30-year, 7 consecutive weeks of lower yields on a 10-year maturity. We could make it week 8. We're down by 2 or 3 basis points on a 10-year to 4.1285. And in the front end of the curve, you'll see the 2-year on an 8-day run of lower yields. We're down 6 basis points this morning, 388.75. That 8-day run, the longest since March 2020. You don't need me to remind you what happened 5 years ago. 2 hours away from that cash open. Let's get you some morning movers. Here's Manus Cranny. Morning, Manus.
John, the risk, of course, to the exceptionalism of the U.S. consumer. Let me take you to Walgreens. Take me private. It looks like Seymour Partners, we understand, potentially bidding $11.30 to $11.40 for Walgreens boots. Take it private, $10 billion deal, and then break it up. Deutsche Bank said it's going to be incredibly difficult to do, complicated. Talk to you about the U.S. consumer. Target, solid set of fourth quarter numbers, but the actual earnings per share is down by 20% year on year. And they warn, risks from tariffs, you got it, weak February sales, and the price increases are coming in the next couple of days. That is the reality of these tariffs. Next couple of days, you're going to feel it in your pocket. A cautious tone is what they're setting. Tesla, quick snapshot, China factories down, the China deliveries, I should say, down 49% year on year, down 51% on the month. That adds into the pain from Germany. By the way, 15% of the Model Y components sold in the US come from, you got it, Mexico. Jonathan.
Manus Cranny, thank you. What an ugly run for that stock after a massive run-up after the election. I want to talk about the front end of the yield curve a little bit more. Traders betting this morning that we'll get 3 cuts in 2025 from the Federal Reserve. This is an 8-day move at the front end of the curve on 2s. Over those 8 days, almost a 40 basis point move lower in the past week or so.
Suddenly we went from possible rate hikes to the likelihood of 3 rate cuts. Andrew Hollenhorst of Citi Economics comes out just now and says on the margins, new tariffs are dovish for the Fed, that we expect the tariffs to essentially negatively affect U.S. economic activity, and thus the Fed will be considering that. Not March, though. And frankly, my question is, will this be enough of a support for markets to really give some boost to risk assets that are falling on the risk that this is not just some kind of negotiation?
The next meeting, March 19th at the Federal Reserve, and they've got to produce some forecast and outlook over on the FOMC. And our radar this morning, President Donald Trump imposing 25% tariffs on most Canadian and Mexican imports and raising levies on China to 20%. The president also proposing a tariff on external agricultural products as well.
So he said no room left to negotiate. Midnight came and went. The tariffs went on. 25% in Mexico, 25% in Canada, 10% we're looking at for Canadian oil. And of course, when it comes to China, an additional 20%. 2 out of the 3 have already responded. We're still waiting on Mexico's response, and I think this is very interesting because they have an A, B, and C plan, and they have done a tremendous amount of work in the past 5 weeks, flurry of diplomacy, to try to make sure these tariffs didn't come on play. Now you look at the calendar. If you were thinking these tariffs wouldn't happen, what do you think now about March 12th, about April 1st, and about April 2nd?
I just wonder how long these tariffs can remain on before there are some consequences. Even if it's not necessarily these tariffs remaining on for a long time, some tariffs are. Is there a sentiment shift in terms of buying American abroad? How does this get sort of translated into longer-term structural trade relationships? And I know it's too early to talk like that, but at a certain point, even if they come off, there are longer-term consequences that people are trying to grapple with.
Do you mean a consumer preference shift, like what we've seen
yes,
in China to some extent?
To some extent, a consumer preference shift. And then you have to imagine that companies are going to gird against that by also shifting supply chains and trying to protect themselves. But yeah, we saw that. I mean, honestly, Tesla is a sort of unique story, but we've seen this over time with Starbucks and McDonald's as sort of the templates for American consumerism. Do we see that again?
I'm waiting for the carve-outs. Wall Street Journal reporting was that Susie Wiles got on a call and addressed and reassured car makers that the administration would consider carve-outs for cars that comply with USMCA, the update, of course, to the free trade agreement during Trump 1.0. Howard Lutnick, though, made no overture. This is to their reporting. Participants left unsure what Trump would do, but the conversations has already started. So you can potentially see where the carve-outs might come to play.
We've seen limited moves in the last 24 hours in autos, and I'd also suggest we've seen limited moves in foreign exchange for the Canadian loonie and a Mexican peso as well in the last 24 hours, and we'll get to that FX conversation in just a moment. Well, let's get you up to speed on the latest over in Europe. The EU said to propose extending 150 billion euros in loans to boost defense spending as President Donald Trump pulls back American security on the continent. In total, countries could mobilize nearly 800 billion euros in defense spending.
So this story is not going away, especially when you have the order last night saying the U.S. military is going to put a pause on some of those weapons that are supposed to be in transit going to Ukraine. What did we hear from the incoming Chancellor of Germany yesterday? A tremendous amount, enormous amount of pressure is now on Europe to boost defense spending. And Ursula von der Leyen, speaking in Brussels, says that's just it.
This is a great time to bury bad news, so let's get to some almost terrible news. A copy-paste error at Citi, nearly transferring $6 billion to a customer's account after a staffer accidentally put the account number into a field for the dollar figure. The error was caught and reported the next business day. But this story follows on from another story we mentioned only in the past week.
Yeah, the idea of $81 trillion accidentally moved to somebody's account, and also from human error. I believe that this happened before the $81 trillion, and people were secretly relieved that this took the pressure off them because, you know, $6 billion is a lot less than $81 trillion. At the same time, it raises the question of manual processes that could be automated, and you have to wonder how much this is going to expedite that plan.
We all want our net worth to be the length of our account number, right?
I mean,
that's the goal.
Yes, although the first, like many of them, might not be numbers that you want to be in the front.
Try and figure that out. Let's turn to foreign exchange. Traders digesting President Trump's 25% tariffs on Mexico and Canada. Kit Jukes of SocGen writing this morning's shocker is the Canadian dollar is up, despite tariffs arriving. Friday's Canadian jobs numbers might be important as the US wants. Kit joins us now for more. Kit, welcome to the program. Let's talk about that muted response, if we can call it that, in foreign exchange. Kit, what gives?
Well, I mean, the big response in the sense has been this is bad for growth in the United States. And you've heard some of that. The market's pricing in rate moves that it wasn't, or more rate moves that it was, and looking negative. We have seen no shift in consensus forecast down in the US GDP growth yet. And we've seen a series of upward revisions to economist forecasters for this year since September that drove the dollar higher. But what we're seeing is the market is going ahead away from the economists. The strategists are getting negative. The traders, the investors are nervous about what this means. So we have a weaker dollar, and that protects the Canadian dollar, where we've been talking about the tariffs for a while, and the Canadian dollar has been beaten up. But I do think it means that it puts more of a focus, in a sense, on growth in North America. What is the ISM service number going to look like tomorrow in the States? What are payrolls going to look like on Friday? And what are Canadian jobs going to look like on Friday? Because all this betting on more rate cuts faster is going to need some validation reasonably quickly to be able to sustain itself.
Kit, are you saying that people expected tariffs to be worse for the rest of the world than the United States late last year and early this year, and that story has shifted, and now people are thinking that based on where valuations are, this actually could be a bigger hit to the U.S. economic growth trajectory based on expectations than the rest of the world?
Yeah, look, I think we start from the U.S. exceptionalism position where we've been revising up U.S. growth forecasts for a long time, revising them down everywhere else, talking about how exceptional the U.S. is, and expecting higher rates than in other places, and watching the dollar get to extraordinary heights. So we're hypersensitive, if you like, to anything that suggests that actually the U.S. economy might really be able to slow. Now, whether it's going to slow as fast or as much as people are contemplating, what you have is a big position adjustment in the market, a growing awareness of the fact that foreigners own $65 trillion worth of U.S. assets, and if they get nervous, that really is a problem. And so, these stories are beginning to happen. The reaction in the market looks big relative to the news flow so far, but I guess that's what happens when you're at a turning point.
Kit, right now I'm looking at the euro that's actually at the strongest level going back to early December versus the dollar. Is this because of concerns about U.S. growth, or is this because of optimism if some sort of spending plan is laid out by Ursula von der Leyen today?
I mean, it's a little bit of both in the sense if you look at it, euro-dollar tracks the two-year interest rate differential painfully closely at the moment. And what's happened? Well, we've taken U.S. two-year rates down, so that's been the single biggest driver of that over the last few days. There is some optimism about the program. There would have been much more optimism into Europe if you'd had a sweeping win for a party in the German government elections last week. I can't remember how long ago it was now. That would have delivered an end to the debt brake that hamstrings their fiscal policy and is completely ludicrous. That would be a bigger game changer. Also, we're saying, we spent the last 2 years in a